You could have paid in late 2023 $500+ for that stock. Now you can buy it for $100 something. And think about how much the market's gone up since late 2023. The stock market can be a great wealth generator, but you gotta know what you're doing, okay? And you gotta put in the work. It's crazy. You would think the stock market, you would think investors would be intelligent enough to know like very simple business law. AI is gonna destroy the business model, all this stuff, right? I understand, I get it. As soon as it starts to move, it'll move 50%. Quick. That's why I'm buying out as many shares as aggressively as I can. Public count dipped just under $1 million to today pushing close to $4 million in the public count. Like what a change, right? At the end of the day, all that matters is there money to be made or not? So let's build a portfolio as strong as the Hoover Dam. You gotta be flipping my flapjacks right on the floor. AMD stock down big here today. Stock down close to 7%. A lot of people want to know why, my opinion on perspective on this. So we'll react to AMD at the front of this video, and I'll share basically what's going on there in regards to AMD stock price, my opinions on it, perspectives, all those sorts of things. From there, we want to talk about Lululemon stock. The stock was down 18% here today. That stock is down 67% now from basically the end of 2023. It has just been absolutely obliterated. So Lululemon's now at very cheap valuations. People are looking at this and like, oh my gosh, the P ratio on Lululemon's at like 11. And we're going to talk about if this is the biggest trap or if this is the biggest opportunity. So I'm looking forward to sharing my perspective and opinions in regards to Lululemon there. Okay. From there, we want to talk about how to construct a great portfolio. I think that's a very important subject, and I'll give you guys some tips and just drop you some gems in regards to this. After that, I want to react to a few videos here. First one up here I want to react to is from 2 hours ago. Lululemon's running out of gas and it's not fixable. Looking forward to reacting to that one, sharing my opinions and perspectives. This one from Goldman Sachs, a job report shows labor market is softening. Basically implicates September cut. This should be an interesting one to react to hear where Goldman Sachs heads at, because wherever Goldman Sachs heads at, Wall Streeters in general are usually going to be there. And what the heck are my stocks doing in the background? We got Elf here, we got Nike here, what in the heck? And then Mohammed El-Alarian on his views on where the Fed's headed and what that means for the market, all those sorts of things. And then the very last thing we're going to get into here today in this video, this is something we put out in the Prep Stock Group, our weekly investor report. Just want to show you guys a couple important things so you can understand kind of where the market's headed from here and those sorts of things. Okay, appreciate y'all joining me as always. Thank you so much for being here. One thing only I need for you guys. Just please hit the like button. That's all. If you just want to smash out that like button for me, that would mean the world. I appreciate every single person that does that, and especially the people that have already done that. You didn't even need me to tell you, okay? So, alrighty guys, by the way, if you want to subscribe to the channel, you can certainly subscribe. We're now at 107,000 subscribers, I believe, here on the reaction channel. So appreciate each and every one of you for being here, okay? AMD, listen. First off, AMD stock since that April low is up 93%. That's versus a QQQ, which is up 38%. That's versus S&P 500, which is up 30%. Okay. If we even want to pull up the other companies you want to compare against AMD, you would compare Nvidia and you would compare Broadcom, right? You would compare those two companies versus AMD. And if we look here, and I don't know why my chart got all messed up here. It's from those April lows. We see Broadcom has outperformed with 114% gain. We see Nvidia has underperformed those two at a 72% gain, and AMD is basically in the middle of the pack, right? So, and obviously it's crushed the market. I mean, there aren't many stocks that have returned 93% since that time. I mean, one of the only stocks I can kind of think of from that time period is probably ELF. ELF 162% gain since then. Okay. Celsius, I don't even know if Celsius is up that much from that particular April low there. Let's check out Celsius. Celsius is even up that much. Celsius up 72%, which is amazing, but it's just like it's not as much as the other ones, right? So the stock's been on fire. So what's going on here? Well, a few things. Broadcom announced a new customer, a fourth big customer. Now there's worries because Broadcom can do custom chips. If this is going to take business away from Nvidia, if this is going to take business away from AMD and all those sorts of things, right? In my perspective on this whole subject, in what people got to understand about this is, I was explaining this actually on the main channel last night. There's plenty to go around for everybody here. Like, when you see the amount of money that's being spent and will continue to be spent over the coming years in regards to chips, this isn't some situation where it's just like one company is going to win the whole thing. Nvidia got out in front of everybody, and Nvidia has been the most direct beneficiary, right? After that, you could probably say Broadcom, and then after that, AMD, but AMD is really just at the very beginning inning of them kind of capitalizing on this. So the fact that people would kind of be freaking out over this is a little ridiculous in my opinion. Like a lot of companies, like Broadcom has like $1 trillion plus valuation on it, I believe. Like literally, I think Broadcom has $1 trillion plus valuation on this stock. Like they're going to have a lot of companies use them. Oh, excuse me, $1.4 trillion market cap. Broadcom's kind of a big deal. Okay, so like, the fact that anybody thinks this is going to hurt AMD, no, it's not. AMD is going to put up phenomenal numbers over the next several years. They have the right chips. They have the right customers. And at the end of the day, people are going to continue to order a ton of Nvidia chips. They're going to bump up orders for AMD chips in a massive way over this next few years, now that AMD's finally in the ballpark. And then Broadcom's going to benefit huge as well. And then you just heard about Amazon and their chips and the Trainiums. I believe there was a massive deal they're doing with Anthropic, if I recall. 3 massive warehouses. I mean, this is a big deal for a lot of companies. There's incredible amounts of investment going through and will continue to for the next few years. The question is this massive investment cycle last like 3 to 5 more years, 5 to 7 more years, 10 more years, right? But that's what's going on there. Now, the other thing that came out here today, and this also brought down the stock price of AMD, was this. An analyst came out and downgraded AMD. Now, it looks like this is the 7,137th best analyst out of 10,000 Wall Street analysts from what it looks like here, okay? So, it always cracks me up when these stocks will move based upon analysts' opinions and perspectives. But when you take an analyst downgrade that comes out on a day like today, along with Broadcom announcing another customer there, right? And like people worried like, oh, there's going to be no money for AMD to make, which is just ridiculous. It's going to affect the stock negatively. And so that's exactly what we've seen today. Is this a big deal for AMD over the long term? Absolutely not. It's literally going to be meaningless in the end. Okay. Next up here, Lululemon. A lot of people are looking at this like, is this stock not a steal right now, right? Down 67% since the end of 2023, which the Qs are up 41% since then. S&P 500 up 36% since then. And people are like, Lululemon, what is going on here? Almost 70% drop. And I mean, it just shows no signs of bottoming, right? I mean, you look at a day like today, the stock was down like 18%. That's incredible. So in regards to the forward P, here's the issue. If you ever see a trailing 12-month P, the same as a forward P, the same as a 2-year forward P, you should get a little concerned. That could mean the company's profitability is getting in a scary place. Now, you might look at this and you might say, well, they're just supposed to be the same amount of profits. It's not usually how it works, right? Remember, forward Ps are going based upon analysts' projections for the next year, and 2-year forward Ps are the 2-year out, right? So when you see them all 11, you've got to be skeptical because usually companies don't stagnate. As with all things in this life, there's no such thing as stagnation. You're either getting better or getting worse at everything in this life all the time. So when I see 11 trailing 12-month P, 11 forward P, 11 2-year forward P, I say, no, it's not what it's going to end up being here, right? There's literally no such thing in this life as the same. You're always getting better or getting worse. You're either getting in better shape or worse shape. Right? Your physical health is either getting better or worse. Your mental health is either getting better or worse. There's no like stagnant. You're either getting better or worse. That's everything in life. Your tree out there in your front yard, it's either getting healthier or it's getting less healthy. Like that's life. And so when I look at a Lulu and I see 11, 11, 11, I'm like, I don't think so. No, that's not probable. What's either going to happen here is Lulu's going to turn things around and be much more profitable than analysts expect, or, which is probably more realistic, they're actually going to see their earnings per share go down quite dramatically over the next year or two, and that forward P is not 11, and it's going to end up being way higher than where it's at right now, which is not a good thing, right? So that's something to keep in mind. Additionally, the U.S. growth was basically there was no growth in the United States. It looked like in the last quarter for Lululemon. That's scary. For a company like Lululemon that's supposed to be a growth company. Remember, Lululemon, we go back to the end of 2023. This stock was $500+. It was priced as a growth stock. So now we have a massive transition that has to happen, and it's an awkward transition. It's a painful transition whenever a company has to go through this, and it's important everybody understands this. Okay, what you have happen is a company like Lululemon will go from having a growth investor base to a value investor base. But listen, that takes a while. Now, the value investors don't step in unless they're confident in that company's profitability over the coming years. If the value investors are not confident in that company's ability to generate net income and EPS over the next several years, they will not come in and buy that stock. They will not come in and buy that stock. And that's what you got to remember in regards to this. What is going on with this wind hat, by the way? It's got like a fuzzball thing on it. It's like bothering me. I usually wear my 1000X hats. Where are my 1000X hats at? Okay. So this is an awkward time to go through. If you're Lululemon, you got growth investors saying, peace out, I'm out of this thing. And you got the value investors saying, I don't know if I want to step in this because your profitability is going down so fast. You got to understand, Lululemon's earnings per share was just down on a year-over-year basis. Down. We got earnings per share going down. We have margins going down. Their margins were going down also. And we've got no growth in the United States. Now people are looking at it like, Lululemon's about to go negative in the United States. Maybe that happens, maybe that doesn't. I don't know, but that's a true fear. When you start posting a goose egg for growth in the United States, people say, next up, negative. The question is, what are we going to see? Negative 2% growth, 5%, 10% revenue growth? That's scary. So the only growth they're really getting right now is China. Now, additionally, when you look at Lululemon, there's been a big change over the last couple of years in regards to this, and it helped out short-term revenue. And I understand what Lululemon's trying to do here, but here's the issue. So I just went to Lululemon, like the front page, and what am I greeted with? Just a bunch of like random clothes, and this is what they're becoming. And now if you go in their stores, they're selling all types of random clothes, and they're gotten big into men's over the past few years and all those sorts of things, right? And so Lululemon, like how they built this business was on the back of an incredibly successful yoga pant. Everybody knows that. It doesn't matter if you're a guy or girl, if you've ever done yoga in your life, everybody knows that, okay? That's how they built this into a billion dollar company. But now they're all about these other things, right? They're about trying to sell to men, trying to sell bags. They want everybody to be their customers. So now they've kind of gone wide here, and that's a tough thing. Sometimes it doesn't work. Now they want to sell you a polo. Now what happens is, okay, you want to sell guys polos, cool. All right, now you got to order massive amounts of inventory. What happens if the dudes say, you know what? I don't want my Lululemon polo. If ever guys out there, saying I want a Lululemon polo, that's great. You're going to sell those, at a phenomenal rate, and you're going to make crazy margins on it. But if you don't, you're going to sit on inventory. Then you're going to have to start clearancing. A clearancing's never a good look for any brand. If you ought to start having a clearance rack, ugh. Or then you can say you can just take the hit and maybe try to sell it downstream to like a Ross or somebody like that. Not a good look either, right? I mean, imagine, somebody that's your usual customer goes into Ross or wherever and they see your product. It's not a good look for a brand to really be in Ross and those sorts of stores. So this is what's going on for Lululemon now at this point in time, and that's tough because somebody said this recently, like Lululemon's trying to become the Gap. Here's the issue: Lululemon's got a $20 billion+ valuation on it. You know what the Gap has on it? $8 billion valuation. $8 billion valuation. Uh-oh. You want to become the Gap? You can do that. That means still another 50+% downside easily from here in regards to your stock price, right? Now, there's also been a lot of competition that's come in the space. This company named Alo has gotten very, very popular in the space. So, they got Kendall Jenner on the Alo. Interesting. So, yeah, this brand has been popping recently. They got this other brand called VERGE, which is, gotten much more popular recently as well. So now they have serious competition. But here's the thing, and this is what I'm always pointing out, because people say, why would you rather buy Nike stock right now instead of Lululemon? Lululemon looks so cheap, right? Here's the issue, ladies and gentlemen, okay? Nike has a brand. Lululemon doesn't have a brand. Nike sells success. Nike doesn't sell clothes. Nike doesn't sell shoes. They sell success. They sell winning. When I went to get 1000X hats made, I said, can I get Nike 1000X hats made? Like, that's pretty cool. Why? Because I want to associate with winning. I don't associate winning with Lululemon. I don't associate winning with Alo or Viore or Hoka or On or any of those other companies. They're just brands. They're here for the hot thing at the moment and then they're gone, right? And I don't want to say gone as in like, oh, they go bankrupt. They just like, they kind of go into irrelevancy slowly but surely. And they still have businesses. They still make money, right? Same thing with Reebok and Adidas and all the other brands and One, right? It's all the same thing. It's one company that actually spent countless tens of billions of dollars on their brand over the years, and they built a brand on success and winning and built a brand on something more than clothing, and it's Nike. And they're the only ones to do that. And so when you ask me why I want to buy Nike over Lululemon, it's easy. Because Lululemon, I don't know where that brand is 5 or 10 years from now. It could be completely irrelevant. I know where Nike is, even more relevant than it is today. There's a big difference there. And so, and what that means for profits long term and all those sorts of things matter significantly. So, just a little something there for you guys, okay? Next up here, let's talk about how to build a great portfolio. I think this is an important subject, and then we're going to react to some videos up here, and then we'll get into the few things I want to show you in regards to the investor report to understand where this market's headed from here, right? But I posted this on X here today, right? I don't show the Patreon portfolio too often, other than obviously if you're in the Patreon, you get to see it all the time. But in regards to Patreon portfolio, this is how you build a truly great portfolio in a pretty quick amount of time, because this was a portfolio I started when I started my Patreon, which was 2023. And the first year we did $150 a week, so not a lot of money. And after the first year, then we switched to $250 a week. So a small amount of money, right, can build a portfolio really quickly if you're a good investor. And so look at how quickly we've been able to build this portfolio to now $53,000 portfolio. I mean, honestly, in the next 24 months, this portfolio will probably be $100,000 plus. That's my guess. Probably in the next 24 months. Maybe it doesn't happen. Worst case scenario in the next 36 months, but I think there's a decent probability in the next 24 months, we're going to be looking at a Patreon portfolio with 6 figures plus, right? Which is incredible because it's been built with such a small amount of money. Such a small amount of money. This isn't like, like we're putting $10,000 a month into it, or like completely unrealistic amounts. Like this has been built on extremely conservative amounts of money. But look at how well constructed the portfolio is across different industries. You got a Palantir, which is so much different than an AMD, which is so much different than Shopify, which is so much different than Elf Beauty, Wynn Resorts, Cheesecake, Nike. Like these are just so many different great companies in different spaces. And the only stock I have that's red in there is Nike right now, right? Which I think if we fast forward a year or two from now, it'll be massively green. But it's not just that. When you build a truly great portfolio, you've got a portfolio full of growth stocks, value stocks, dividend stocks, GVD. I always preach it. GVD 1, 2, 3. Making sure you got 3 stocks in each category. And if we go through the portfolio, we've got at least 3 value stocks here, at least 3 dividend stocks, and at least 3 growth stocks, right? That's how you truly construct a great portfolio. Are they in different industries, or do you have a good mix of top tier growth companies, top tier value companies, and dividend companies? And if you look, like, oh my gosh, you look at my growth stocks. Are these not some of the best growth stocks you've seen? And remember, I took huge profits on Tesla, by the way, in regards to the portfolio. But, when you think about some of the best growth stocks in the market, right now and over the next few years, like Palantir is going to come to mind. AMD is going to come to mind. Shopify is going to come to mind, right? Elf Beauty is going to come to mind, and I own them. When you think about some of the greatest, value stocks, dividend stocks over time, companies like Wynn Resorts will come to mind. Companies like Nike will come to mind. Cake's been a great performer, right? Meta and Google now, even though those companies both have great growth, they're also kind of value and dividend stocks because of where those stocks trade at. So if we pull up the compare feature here on 1000X, you guys will see how cheap Meta and Google McDougal trade here. So let's type in both these ticker symbols. Okay. And take a peek at this. So Meta forward P26, Google forward P23. These stocks trade really cheap, really cheap. I mean, the market in general is at a forward P of 20-ish. So they're barely above a market multiple, but the growth rates, look at next year expected growth rate from Meta, 17%. Look at Google next year expected revenue growth, 12.6%. Current year expected revenue growth from Meta, 20+%. Google, 14.5%. That's growth. Those are growth companies, but they're trading at value pricing, and they pay dividends. So phenomenal stocks there, right? And so anyways, the portfolio is just very well constructed. That's how you build a truly great portfolio. Do you own a bunch of different stocks in a bunch of different industries that are top tier companies, right? Top tier operators. And are they a good mix of growth, value, and dividends, right? By the way, if you guys ever want to follow me on X, I always have that linked in the description area of all my videos, okay? Let's go ahead and let's react to some videos.
In Lulu 3 years ago that others missed.
It was pretty simple. It's the core of the business was running out of gas. And the company, as a result, was trying to expand beyond the core, selling sweaters, sweatshirts with logos on them, Little House on the Prairie skirts that were down to your ankles. That's not Lululemon. So the company we saw was basically trying to stretch for more growth, and it didn't work. So
pun intended.
Pun intended, yes. And now it's running out of gas.
Is it fixable?
It's not fixable because when they were growing very quickly, there was no competition. It was Lululemon was the it company in the it space, especially during COVID, which accelerated the growth of athleisure. What has happened since is there's a ton of competition coming into the market. Alo and Vuori are a big problem for this company.
There's an Alo store near me. There's a Vuori. I get the catalog.
Is it fixable? I think that's a great question. That's a very direct question. Is it fixable at Lululemon? The answer is not really. Not to a great extent. And the reason being is they just haven't invested in the brand the way they needed to invest in the brand. And they chose to make short-term margins and profits rather than focus on the brand. And listen, Nike could do the same thing. Nike spends billions and billions of dollars a year on sponsoring leagues and athletes and all this stuff. Nike could easily just say, you know what? Screw it. We're not gonna have the best athletes. We're not gonna, have our logos all over the jerseys and all this sort of stuff. You know what? We're done with all that. And you know what happened with Nike margins in the short term? Skyrocketing margins in the short term. You know what happens to the brand over the long term? Destroyed, because over time Nike would stop being as viewed as like success, right? And so it just kind of like falters. And that's always the downfall of these companies. I've been explaining this for the last year or two in regards to this as I've been acquiring my Nike shares, right? Because people are like, well, what about this brand? I'm always explaining to them, you understand decade after decade, brands come and go in the apparel space. And the reason they come and go is consistently because no one understands the way you have to invest in your brand if you want it to be lasting for the next 40, 50 years. And Nike's the only company who has really understood it on that deep of a level, and that's why they remain relevant. I mean, Nike's been in the toughest times they've had in a long, long time over the past year or two. And guess what? Nike's worst times is still better than everybody else's best times. So, it's very important. You got to understand the strength of a brand when you're selling to consumers. It's massive.
The Alo store always appears to be packed.
Yeah.
I don't know who they are. If they're public, I don't think so. What are they doing right that Lulu?
Yeah, in Alo, I mean, they could be super packed and super relevant right now, and 5 years from now, no one goes there. That's how it is with these brands. They come and they go, and they're just they're the hot thing, then they're not the hot thing, because no one actually wants to spend the margin and invest in the brand the way you need to invest.
Maybe it's getting wrong. Just no ankle length skirts. I don't know.
I think Alo and Vuori they're sticking to their identity. They have a good casual offering. Their fabrications are great, and their marketing is on point. So what's really scary today is both Alo and Vuori separately have over 100 stores across the United States. That's a problem for Lulu because, again, 5 years ago, these companies, you've never even heard of them. A lot of people haven't even heard of them today, but they're...
Well, we had Athleta, right? Or Athleta?
Yeah, well, gets owned by the Gap. That's more irrelevant these days. But
even more irrelevant.
More irrelevant, but... The problem with Lulu is actually the key is where it is relevance. It's still a relevant brand, but it's becoming less relevant to the consumer. They're losing their core customer, and that core customer is going to Alo and Vuori.
Well, let's talk about the consumer, because we have the jobs number out today, and it was much weaker than expected. You guys have had, it's a Wizard of Oz theme. Lions, tigers, and bears, oh my, on the consumer. What is that, and how do we read it? And who's going to win? Because somebody's going to win.
Yeah.
Or maybe not.
Great. Thanks for bringing up the Wizard of Oz. It's our negative thesis on the consumer. We talk about lions being negative mall traffic or choppy mall traffic, tigers being rising inventory. So inventories are rising in the retail space for the first time in a number of years, and they're now exceeding sales growth, which is pretty concerning. It means
good for TJ Maxx.
Well, good for TJ Maxx, yes, but not good for most of the mall retailers that are finally bears, which are at peak margins and earnings. So if you really think about this, 2024 was the best year for retail in 20 years. So if you take that and say, hey, wait a second, mall traffic is starting to get choppy and going towards a declining trend line. If inventories are rising faster than sales growth, if comparisons are at peak, they're best they've ever done, and finally, oh my, you bring in tariffs. That's going to be a problem for earnings per share.
Retail's a brutal business, man. I had to learn that over the years, over the last 17 years I've been in the market. Retail stocks, so hard to invest into. Brutal, man. I've tried to invest in many retailers. A lot of them I made money in, but small amounts of money. Like, oh, I made like 10% in the stock or 20% or, you know, it's tough to make money in retail stocks. I'm just going to be honest with you guys, because it's like they'll be dead in just dead stocks for years. Then they turn it around. And as soon as they turn it around, something bad happens in the economy or something bad happens with a tariff situation or something like that. Stocks are leveled again. It's just, they're probably the biggest, retail stocks are probably some of the biggest money traps in the stock market. Them and oil and gas stocks. Like, if I think about some of the biggest money traps, oil and gas stocks and retail stocks, because they'll make a ton of money at a particular time, and then, you know, the stocks will start going down before the business turns down, and then after the stocks already gone down, then the business actually starts going down, because they're kind of like very cyclical, and something happens, and it's just a mess, man. It's just a mess. So anyways, big money sucks. Retail and oil and gas stocks. Goldman Sachs.
To discuss, welcome back, Jan.
Hi.
Good to see you're still here after the president's assault, which we'll talk to you about in a moment. But just reaction on jobs to this weaker print.
It was a little bit weaker than we had expected, but we've been looking for a somewhat soft report with an increase in the unemployment rate, with a sort of sub-consensus job gain. I think the implication is that the labor market continues to be pretty slow. Hiring is very slow. Layoffs are still low, but the labor market's softening. And my main takeaway is that this seals the case for the cut in September that we've been looking for a while, and probably additional cuts beyond that. We have cuts in October and December as well, and I think that looks quite likely. Obviously, that's going to depend on the data, but I feel very good about the forecast.
There's also
So yeah, he's 100% right. You know, anybody that tries to gaslight you and tell you, oh, the economy's booming right now, it's amazing. No, baloney, it's not. It's also not a disaster zone. We're in an okay economy. Like, we've been in, honestly, for a while now at this point in time. It's not like this is new. I feel like we haven't had a booming economy really since kind of that 21 into very early 2022, right? And then as 2022 continued on, it felt like things started to slow. And then I feel like it's just the last, honestly, few years have just been kind of meh. And I feel like that's still kind of the situation. And it's like, you can't really call it it's no great financial crisis type recession going on where it's like, oh my gosh, it's devastating out here. You can't make a dollar. But it's also not boom times, which is kind of where you should be, to be fair. If you come off of a big inflation cycle, this is really what it should feel like. This is kind of what it should be like, right? And when the Fed's lowering interest rates, this is kind of what it should feel like. Like, you don't want to really be in a situation where you got a booming economy and the Fed's lowering interest rates. That means you're probably setting yourself up for a massive inflation spike if that's happening, right? We don't have that. Additionally, you don't want to feel like you're in a massive recession when the Fed's cutting, because then that just feels like, oh, awful. Like, they're cutting because they're in panic mode, right? So honestly, the economy we're in, the jobs market we're in, it's about where you should be given all the factors that we've had over the last 5 years.
Debate about whether the Fed can start cutting now and help shore up the job market. Does it work that way?
Well, that's the idea, that you move closer to neutral, and that supports the job market in a period during which hiring is quite soft. And yeah, at the margin, that should be expansionary and shore up the job market, as you say.
There was some discussion yesterday out of ADP that maybe the break even was higher than we think, and that it might have resulted in a 4.5 print today on unemployment. Did that make any sense?
Well, 4.5 would have been a very large increase. So I thought, I don't think that was really on the table. Obviously, month-to-month changes in the unemployment rate can be noisy, so you always want to look at a range of different indicators. But we'd been looking for 4.3%, and that's what we ended up getting.
Yeah. When it comes to Trump, let's be very clear. This is his time to, 2025 has kind of been the year where it's just like, we're trying to put everything in place for 26, 27, 28, right? It's kind of still the Biden economy and all those sorts of things. But I'll be honest, Trump needs the economy to pick up significantly next year. There's going to be a lot of pressure for the economy to get moving. If the economy worsens next year, that's going to be a horrible look, because next year, all this big, beautiful bill stuff, all that starts to supposedly positively affect the economy, everything like that in 26 and beyond. So there needs to be a significant pickup in the economy in 26. We got to feel like, oh, now we're picking up steam. And I feel like we haven't felt like that yet in 25. I don't feel like it's like, oh, the economy's really picking up. We've got to get to that place in 26 or Trump's going to be in trouble come primary time. We got to feel like, oh, things are really picking up. Like the back half of 26 is going to be great. 27 is going to be great, right? If things worsen next year and it feels even like, oh, the economy is even slowing down more, it's getting worse, we're in recession or heading to recession, oh, watch out for that late 26 election, okay? All right, Powell's taken too narrow a view.
You have been fairly critical of the Fed. You've also been critical, but fair. And as the job market has been slowing for over a year, some, like the guy in the White House, are wondering why the Federal Reserve has not already begun to act on interest rates. Outside of those rather, some would say, bizarre cuts last fall, we asked my ex-audience, Twitter, what it thinks. I asked, by not cutting rates this year, the Fed is A, doing it right, or B, getting it wrong, Mohammed. 67% said the Fed is getting it wrong by not cutting rates sooner or more aggressively. Would you agree with that take?
I agree with the 2/3 who said that they have been getting it wrong. There was a bunch of us outside and inside the Fed that were arguing for a July cut. And our concern, which is playing out in the data, is that Chair Powell had taken too narrow a view of the jobs market. And by that, he was ignoring the weakness that was starting to come to the surface. And the problem, as you know, Brian, is if you don't address weakness in the labor market, it becomes non-linear. It accelerates and it becomes much more damaging. So yes, I think they have gotten it wrong. I think once again, they're late. They will cut in September. And I suspect there will also be a discussion, should they cut by 25 or 50? And where you end up on this depends on whether you think the labor market has a demand or supply problem and what you think the inflation dynamics really are.
Yeah, I agree 100%. They're late. My opinion there hasn't changed. All right, next up here, I just want to show you guys a couple things inside our weekly investor report. We put this out to the private stock group members each Friday afternoon usually, okay? And by the way, if you're in the private group and you never knew about this, we have a Discord tab and it says like weekly investor report or something like that. You can click on that. You can look at the past ones as well, right? And it's just to give everybody a snapshot of what's going on in the markets, the economy, things like that, because I understand not everybody can do this full time. Like a lot of our private stock group members run companies, they run their own little business, right? They work at 40, 50 hours a week, so they don't have time to pay attention to every little thing going on in the economy. So this is supposed to be like a great snapshot into what's going on in the market, what's going on with the economy, things like that. And there's just a couple things I want to show you guys here. One is this is the latest AI investor sentiment numbers. Awful. It's still awful, man. Like, look at this number. 43% bearish, only 32% bullish. It's been overwhelming bearishness. And keep in mind, usually there's overwhelming bullishness. That's a usual market. There's been overwhelming bearishness since February, folks. Really since like the end of January. And you can look at the historical data. It's bad. So, but at the end of the day, like, market's been pretty good this year, right? Obviously, we had the drama show, the severe correction, but at the end of the day, like, it's been actually pretty decent, which is fascinating considering how bad things have been in regards to sentiment, right? Fear and greed index this week kind of more at a neutral place. Last week was a little slight greed in regards to that, right? And then as far as the latest consumer sentiment numbers, they came in at 58.2%, which is down from July 61.7%. So kind of a surprise that consumer sentiment got worse last month. If anything, I was expecting that to get better. And once again, these are things that, earlier I spoke about, like Trump really needs a lot of this stuff to turn around. He needs in 26 consumer sentiment to be improving a lot. He needs the job markets to improve, the economy to improve, and the Fed to continue to lower rates. And then, come election time, the primaries, like, maybe things could be looking a little better. Or I can call it primaries. It should be midterms, right? Midterm time, like, we could be looking better. If I'm telling you, man, if things get worse, if the sentiment gets even worse, if the economy gets worse, those midterms can be tough. So, keep that in mind. We'll talk about why did I buy this stock. I'm going to share in this video my bull case, bear case, and my base case for the stock and where the stock price is headed over the next few years. I'll give you my price targets. We'll talk about what stock it is, obviously. We'll talk about how big of a buy I did today. We're going to talk about how much money I'm looking to put into this stock. Am I going to make this like a core position for me? And all those sorts of things. So we're going to speak about that in today's video. We will discuss briefly why Amazon stock popped big today. It was up 4%. Some major good news came out for anybody that's an Amazon shareholder out there. Elf Beauty, anybody that's an Elf Beauty shareholder out there. We'll talk about why this stock continues to pop up another 4% here today. Now up 1,759% in the public count. That stock has been a tremendous performer. I remember Elf Beauty was $50 back in that April, we can call it severe correction. And you're looking at a stock today that's $135. What a comeback. Okay. Additionally, I want to give some advice, some motivation to some people out there that have been wrecked in the market the last 2 or 3 months. Now, some of you might be watching this right now and you're like, what? How are people getting wrecked in this market over the past few months? Like, you should be near all-time highs, at all-time highs, within a few percent of all-time highs of your portfolio. Yeah, you should be. But unfortunately, that's not the situation. We have a lot of retail investors out there getting devastated right now. And I want to take you guys through all these like popular stocks that are just getting obliterated. And I want to give some advice to some of those individuals out there, motivation. And if you're one of those people that's not getting wrecked, which I hope you are, I hope you're, doing great. But I'm going to give you some signs and some, let's call it, some advice to make sure you don't get into some bad situations in the future that next thing you know, you're in a really bad situation. Okay. So I hope you guys will enjoy that advice and motivation. Okay. One thing all I need from you guys, I hope you appreciate me doing these videos for you guys day in and day out. The only thing I ask in return is for you to smash that thumbs up button. That's all I need from you, man. If you could just please hit that like button, it will mean the world to me. And thank you for everybody that already hit the like button before I even said that, okay? Additionally, if you want to be subscribed to the channel, you can certainly subscribe. We're well over 880,000 subscribers on the channel right now, okay? Listen, I want to show you guys some very popular stocks that are getting wrecked right now. And what you can do to avoid this, and if you've been caught into some of these, what do you do? Okay, listen. Duolingo, we call it Little Dingo. This stock over the past 3 months is down. It's basically lost half of its value. Let's just call it that, okay? It's down 47.5%. The stock has roughly lost half of its value in the past 3 months. 3 months. Meanwhile, the QQQ is up over 8%. The S&P 500 is up over 8%. That's awful, man. And there's a lot of people caught into a stock like this. CoreWeave, very popular stock that had been talked about so much on CNBC and all the financial networks, right? CoreWeave, the IPO. This stock since mid-June is down 51%. Over that time, the Q's up about 9%. S&P 500 is up 8.6%. Circle, oh my gosh, Circle was all the hype. Well, since mid-June, Circle stock has fallen 58%. And once again, the stock market indexes are up 8% since that time. Since mid-July, Cava, however we want to call it, very popular, hyped out restaurant chain, is down about 30%. Since mid-July, folks. I'm recording this video at the beginning of September. Today's what, September 4th or something like that, right? And the S&P 500 is up 2%. The Qs are up 2% since then. Meanwhile, the stock has lost 30% of its value. Over the past month, Figma stock is down a whopping 57%. Figma had all the hype, all the excitement. Oh my gosh. Is down 57%, while the S&P 500 is up 3.8% and the Qs are up 3.2% over that time. This is since the end of July. HIM stock is down over 30%. Quantum computing, a very popular quantum computing stock, that was all the hype just literally a few months ago. This is since the beginning of July. The stock's down well over 30%, while the S&P 500 and the Qs are up 3% each. Okay, alrighty. Okay, first off, there's nothing worse in the stock market than getting destroyed while like the market's going up and up and up, and you're like, you start looking at yourself and you're like, how am I getting so destroyed while the market's going up, right? It's the most devastating feeling. Like 2022, for instance, right? Like that was a devastating feeling in terms of like, oh man, portfolio is getting smashed. Like going into 2022, I think the public count was, my guess is somewhere between 1.5 and 1.7 million. By the end of 2022, it was like right around $1 million. Like boom, got smashed. But everybody was getting smashed in 2022. It was just a question of how hard were you getting smashed in 2022. That was the only question. The worst feeling is when the market's going up and you're going down 30, 40, 50% on stocks, and you're looking, you're like, what's going on? And what that can lead to is jealousy, envy of others, right? And the worst thing it can lead to is feeling like the stock market's a scam, because you're going down 30, 40, 50, 60% on positions. Meanwhile, the stock market's going up and you're like, this is ridiculous. The stock market's a scam. Listen, okay? The stock market is arguably the greatest wealth builder in the creation of mankind. It's unbelievable the wealth you can generate in the stock market. The stock market changed my life forever, I can tell you that much. But you know why? Do you know why you're having a lot of trouble and you're getting devastated on stocks? Do you know why? You want me to tell you the actual truth? Because you're not putting in the work. You're not putting in the work. You're gambling. You're gambling in the stock market. And you may say, well, everything's technically a gamble when you make an investment, right? True. But the question is, are you stacking the odds in your favor, or are you stacking the odds in the other side's favor? And the issue is, if you're putting in no work and you're just like gambling money around, you're just like watching a YouTube video, or you heard on Instagram somebody said this was the next hot stock, or you looked on X and somebody said, oh, this stock's going to go up a lot, and you're buying these stocks, and somebody said on TikTok, TikTok, this stock's going to go up a lot, and you're just buying stocks like that, you're a gambler. You're scamming yourself. The stock market's not a scam. We're all making a lot of money. But you're scamming yourself if you're playing that game. You're just gambling money around like crazy. And it baffles my mind, because people will try to save $1 here, $1 there. You know, they'll look at the menu at the fast food place and be like, I'm gonna better order this instead. And then they'll just gamble their whole life savings on just random stocks that they have no clue about and they haven't really researched deep or anything like that. And it's like, well, what are we doing here, guys? Okay, so stock market's not a scam, but you're scamming yourself if you're doing something like that, right? But all these feelings of like jealousy, envy, hate, all that stuff can come, right? You know, I was even reading comments here. This was a comment on the channel. I think on the last video I produced, it said, it's strange. The first dozen times I listened to Jeremy, I was a bit dismissive. I thought he was a bit cocky. Now, maybe a year in, I realize this is one of the straightest guys doing stocks on YouTube. I just hope I've got the discipline to follow. We're going through a consolidation. My accounts are doing roughly the same. This person said, Jeff said, same story for me. The first impression wasn't good. As long as there was an impression, I guess you can say, I guess my goal is I want you to either hate me or love me when you see me, right? But this man really knows his stuff. He's all about fundamentals, valuation, hard work, research, and consistency, the long game, baby, SWOT analysis, right? But, you know, I show my portfolio all the time, public account, right? And that could come across as cocky. Extremely confident individual. We all know that could come, if you're not used to that sort of level of confidence, that can come across as cocky. I show my Ferrari, I show the other cars, I show my house, all that sort of stuff. That could certainly come across as cocky, and that's fine. But you got to understand, where I came from, when I came into this world, my family was on food stamps. My first job was Einstein Bagels, cleaning dishes for $7.50 an hour. My second job was Walgreens, making $8.25 an hour. From there, my first good job was being an overnight assistant manager at Quick Trip. So you got to understand, when you come from the bottom and then you climb up here like this, I'm going to show my stuff. I'm going to be proud of it. I'm going to, be proud of what I've, been fortunate enough to accomplish. And I never take it for granted, but I'm going to show it, I'm proud of what I got. So, and you just got to understand, for somebody like myself that comes from where I came from, we're going to show it. Someday I'll be old money. Someday I won't want to show anything, right? Someday I'll be private, I'll just get driven around in a Rolls Royce and that'll be that. But we're not at that phase. I just got all this stuff really in the last 5-10 years. And so I'm going to show it. And also it's motivational to other people to see that sort of stuff, right? So I understand it can come across as cocky, but I think a lot of that can sometimes come from the jealousy or envy of seeing somebody that's got the stuff you want, got the portfolio you want, right? Oh my gosh, the portfolio is nearly $4 million. And that's just a public account. I don't even show my private portfolios. I don't even flex those. I just show the public account, right? He's got the cars, he's got the house, all that sort of stuff, right? Next piece of advice I'm going to give to everybody out there, this is very important. Math matters. Math matters. What do I mean? So I thought this was a perfect time because my son was working on some math. He's homeschooled, by the way. My kids are homeschooled. But math, it matters in the stock market. What do I mean by that? Okay. The math is income statements, balance sheets, cash flows, trailing 12-month Ps, forward Ps, price to sales ratios, 2-year forward Ps, math, numbers. This stuff matters significantly. If you're a gambler in the market, you don't care about numbers. You don't care. You've probably never even looked at an income statement or a balance sheet or a cash flow of any of your stocks you own, right? You probably have no clue what the 2-year forward P is for the stock you own or any of the stocks you own. You probably have no clue what the price to sales ratio is for your company versus other companies. How many people am I talking to right now? How many people are watching? Do you know the price to sales ratio of your company versus peer companies? Do you know the 2-year forward P that is likely for your stock and versus their competitors? Have you looked over the latest 3 balance sheets of the companies you own? These are all fair questions, right? The math matters. If you don't care about the math, it will always come back to bite you hard. On 1000xstocks.com, we have intermediate projections, we have advanced projections, okay? On these projections, you've got to be able to, you're never going to get it perfectly right? You run projections on a stock, that's why it's called projections. You're never going to get it perfectly right. But you've got to be able to run projections on a stock with some level of confidence. So if you own Adobe stock, you've got to be able to run a bull case, a base case, and a bear case for Adobe and have some conviction that, your numbers are likely right because you've done enough research to understand why this company's likely going to grow at this growth rate versus that other growth rate and those sorts of things, right? The net income, what's a fair PE for that stock? You got to be able to run a bull case, base case, and bear case on a stock. If you can't do that, you're a gambler in the market and you just got to admit what's going on there. This is our advanced projections tab. There's probably a lot of people looking at this right now like, what is that? If you don't know what that is, you have no clue how to even perform that, we gotta get you up to a higher level. This is the type of stuff. This is a real work that you gotta put in. Nothing in life is just given to you. You gotta put in the work. I hate to break the news to you. Nothing in life is just oh, here you go. Oh, you want to be a millionaire? Here you go. No. You want to get the big bucks. You want to have the big bucks. You got to do stuff like this. You got to run projections. You got to do enough research to then have an understanding of why a company will grow at this rate versus this rate versus this rate. That's what you got to do. And it's fine. If you don't understand what I'm looking at here, my private group is there to help you. My private group can teach you all this stuff. It gets you access to 1000X. All my courses teach you all this. But you know what people would rather do? A lot of people would rather lose tens of thousands of dollars, hundreds of thousands of dollars gambling on stocks than just actually doing the work. And it baffles me. I'm like, it's crazy to me. How you ever expect to be a millionaire, multimillionaire if you're not going to put in the work? You think you're ever going to be up here, 7-figure Hall of Fame, or even 6-figure Hall of Fame if you're not really, ready to put in the work? Like, it's all laid out for you right there. I give you access to the software. I give you access to all the courses, teaching all this stuff. And yet people would rather, lose $15,000 on their stocks and lose $50,000 and $100,000 and $200,000 than just like put in the work. It's like, it's right there, man. Pin comment down there. If you're ready to take things up to a higher level and actually learn this stuff, pin comment. It's up. It's right there for you. Or choose to do what these other people are doing and, losing tens of thousands of dollars left and right. And, it's one thing is about losing the money, but the other thing is about what about all the money you can make in the market? The public account, if we go back 3 years ago, the public account was around $1 million. It's nearly a $4 million portfolio now. Imagine all my private portfolios, where they were at 3 years ago versus where they're at now. Just think about that for a moment. This isn't small money, folks. When we talk about how to play this game on a high level versus not a high level, we're talking about easily hundreds of thousands of dollars or millions of dollars or tens of millions of dollars up for grabs. And it's like, do you want the money? Do you not want the money? Do you want to know what you're doing? Do you want to put in the work? Do what you want to do. I know what I want to do. Next thing up here, this was a perfect segment because, I was prepping this video and Lululemon earnings came out. And Lululemon stock is going down big. You can buy that stock right now for $100-something, right? And it made me think, avoid FOMO hype. A lot of people get into FOMO hype in the market, right? And I take you back to the end of 2023, late 2023, Lululemon had crazy hype around it. And I was warning people back in 2023 about Lululemon, and I'm like, listen, man, they're very just caught up into a product. They haven't really built a brand yet. That could lead to some trouble. Oh, has it led to trouble? If you go back, that stock was $500+ back in late 2023. And now you can buy it for something with a 1 in front of it. Think about that. You could have paid in late 2023 $500+ for that stock. Now you can buy it for $100-something. And think about how much the market's gone up since late 2023. Market's done very, very well for itself since late 2023. But Lululemon stock has just been obliterated since then. But that's where you got to understand business models on a higher level, understand the risks involved. But not a lot of people even understand the risk factors with these businesses, right? And think about all the stocks you could have made so much money in since late 2023. And meanwhile, Lululemon's given you, a 60% or whatever decline. Brutal, absolutely brutal, okay? So listen, folks, the stock market can be a great wealth generator, but you gotta know what you're doing, okay? And you gotta put in the work. If you know what you're doing and you put in the work, the chances you're gonna have success go up immensely. As with every other thing in this world. If you want to learn how to cook well, guess what? You need to learn how to cook well, right? If you want to cook a great dish, you want to put on a great dinner for your family, learn how to cook well, right? And then put in the work. And you'll make a great dinner. You'll make a great dinner for your family, okay? That's the bottom line. And the same thing with the stock market, the same thing for anything in life, right? You want to know how to become a mechanic? Well, learn how to become a mechanic and then put in the freaking work. And you'll become a great mechanic. You'll be able to diagnose what's going on with the car, what's the problem, and snap of fingers. Boom, you got it. That's everything in life. You want to get really good at golf? Learn how to play golf really well and then put in the work. Go get on that driving range for a few hours a day, every day. Go chip, go putt every day. And believe me, you'll become a very good golfer. You're not going to become Tiger Woods, right? Just like you get really good in the stock market, you might not ever become Warren Buffett. That's okay. You don't need a $100 billion net worth. I'm sure if you had a $100 million net worth, you'd be a very happy person, would you not? $10 million net worth? You don't even need to be in remotely close to the same league as Buffett. Just think about how happy you would be if financially today you had $10 million in your portfolio. If you had a $100 million portfolio. Just understand $10 million in a portfolio or $100 million in a portfolio is a complete an utter joke compared to somebody like Warren Buffett. You're not even in the same sentence. It's a joke. But think about how great your life would be financially. Be able to do all the things you could ever imagine in this life. You want to put in the work, you want to learn, and you want to mess around. It's up to you. Just, sad. People gamble and now they're down huge and the market hasn't even gotten hit. Imagine how devastated they would be if the market got hit. Imagine S&P 500 went down 20%. These people are losing 30, 40, 50% plus on these stocks in just the past 1 to 3 months. Imagine the S&P 500 goes down like 20%. Oh my gosh. These people would be down 70, 80% on their portfolios. It would take them years to even try to attempt to climb back to where they used to be. Amazon, next up here. Why the big pop in Amazon here today? Stock was up about 4%. We're now up $146,000 on Amazon. It's been a tremendous performer in the public count and a lot further to go here in regards to Amazon. So Amazon, what's going on here? Well, the stock was up big as a relationship with artificial intelligence startup Anthropic is helping drive its data center build out and the upcoming ramp of its in-house Trainium chip. SemiAnalysis reported Amazon Web Services, AWS, is currently building 3 data center campuses for Anthropic, which will total 1.3 gigawatts of capacity. These centers are expected to primarily use Amazon's Trainium chips. Amazon's data centers will hold the largest cluster of non-Nvidia AI chips with nearly 1 million Trainium 2 chips in its biggest campus. Although the chips do not possess the power of Nvidia's most powerful processors, Anthropic was involved with the design process, meaning the chips deliver specifically what Anthropic needs to run large language models, LLMs. Barclays analyst Ross Sandler, I don't think he's related to Adam Sandler, also identified the potential for an acceleration in Amazon's revenue in quarters ahead, due in part to contributions to Anthropic. Anthropic's primary revenue driver stems from high-value enterprise deals, big companies, which contrasts with competitors like OpenAI and their individual consumer approach through ChatGPT subscriptions. Okay, so big news in regards to Amazon, because now you view Amazon as, okay, Amazon's a play on e-commerce. Amazon's obviously a play on AWS, and that's part of this story, right? Amazon's a play on advertising. Those are the 3 big businesses. But now you're looking like Amazon's actually kind of a play on semiconductors. And it's fascinating, right? And they really are in a good position with their chips to continue to scale this out and build this out. And so, Nvidia is always going to have the most amazing all-around chip. From there, it's going to be followed by AMD. But somebody like Amazon steps in, and they're able to deliver great quality chips, maybe not quite as impressive as Nvidia or AMD, but specifically targeted for specific customers that then those companies are able to, let's call it save a lot of money versus paying the margins at Nvidia, because Amazon's going to way undercut the price of an Nvidia chip or something like that, right? So, but you also think the other thing you got to understand, like some people might read this as, Nvidia's doomed, AMD's doomed now. Like you understand there's such a unbelievable need for these semiconductors over the next, long bit of time here, that you're always going to need the top level chips from Nvidia. You're going to need the AMDs that are like right close behind there. And then you're also going to need some custom solutions as well, depending upon your surface. So there's plenty of money to go around. There's plenty of money to go around for Nvidia, for AMD, and for somebody like an Amazon who's designing custom chips, and a few other companies that are in that space. Like, some people might look at Broadcom or somebody like that. Okay. So moral of the story is here, folks. There's a lot of people making a lot of money from this. It's not just Nvidia and that's it. And we're going to continue to see a lot of other players make money. And another direct beneficiary, obviously, TSM. I mean, TSMC, like they're, it really doesn't matter what type of chips being done. TSMC is like making money off basically everybody. Like I would guess TSMC is going to be doing the Amazon chips. They do the Nvidia chips. They do the AMD chips. So if you want to just a way to make money from everybody, TSMC is not a stock I personally own, but if you want just a way to make money from everybody that sells chips, like TSMC is kind of a direct play on that, right? Now, Next up here, e.l.f. beauty stock popping big. I don't know what happened to my e.l.f. screenshot here. Obviously, the stock's been tremendous. I spoke about this a little bit last night on the Reaction channel. Jeremy Lefebvre Makes Money. Not sure how many of you guys follow me over on that channel, but I had some great news in regards to a few stocks in that video. But one of them I spoke about is e.l.f. And e.l.f. just continues to benefit from this. They're about to go through a super cycle of growth, essentially. And so, just a lot of people are coming into a stock like that. Celsius is another one. Like e.l.f. and Celsius is going through like a super cycle of growth over the next kind of like 12 to 18 months. And there's just a lot of people wanting to position in for that growth because, you're going to look at a company like e.l.f. and a company like Celsius, and you're going to see some of the best growth rates in the entire stock market. You heard me right. When you look at what e.l.f.'s growth rates will be over the next year, when you look at Celsius's growth rates over the next year, it's going to be hard to find any stocks in the entire stock market that have growth rates higher than that. So they're going to be what's called king stocks, that they're just like overlooking the whole stock market and are like, look at our revenue growth. Who else has got that? And let's be honest, everybody wants a company with the big revenue growth, and they got it, right? And the great news is, with those companies, they're not like some sketchy business model you never heard of that you're like, I don't know if they'll ever be able to make money. Like e.l.f.'s a cosmetics company. Celsius is a drink company. That's the best part. Alrighty, next up here, brand new stock I bought here today. Why this stock? I'm going to share my price targets with you, my bull case, bear case, all that stuff, how much money I'm looking to put in the stock, how big of a buy. Oh man. Yeah, we're going to get into all that, okay? Listen, what stock? Well, I'm going to tell you, it's a dog stock. It's a dog stock. I've been on this kind of like, I'm buying some dog stocks right now. And it's not new. It's really like I feel like this past like year has kind of been me buying dog stocks. There's a lot of stocks out there that haven't benefited, that haven't done anything in years. And when I say dog stocks, I'm not talking a little cute dog. I'm talking a barking chihuahua. Everybody hates it. There might be somebody on here that loves barking chihuahuas, but I think most people watching this do not like barking chihuahuas. They're very annoying, and we're like, come on. And this stock's a barking chihuahua. It's, a stock that people look at and they're like, this stock just sucks. This stock is just the worst, right? Now, when I show you this company, tell me, does this look like a bad company to you? Here's the deal. The balance sheet, cash and cash equivalents, over $10 billion. Marketable securities, over $5 billion. Strategic investments, over $5 billion. Their non-current debt is $8.4 billion. If we look at total assets, they're at $97 billion plus of total assets versus $36 billion in total liabilities. Anybody who knows anything about a balance sheet says, that's a great balance sheet. That's a great balance sheet. What about its income statement? Well, in its income statement, their total revenues went to $10.2 billion in its latest quarter versus $9.3 billion of revenue. Their gross profit went to almost $8 billion of gross profit in this quarter versus $7.1 billion of gross profit in the same quarter last year. Income from operations went to $2.3 billion from $1.7 billion in the same quarter last year. Diluted EPS went to a shocking $1.96 versus $1.47 of diluted EPS in the same quarter last year. Wow. Okay. Does this look like a bad company so far? The company since IPO is up 6,400%. That's since its 2004 IPO. But like I said, the stock is a barking chihuahua right now. Everybody hates it. The stock is down 10% the past 5 years. That's brutal. You know why? The Qs are up over 90% the past 5 years. So you're looking here and you're like, oh my gosh, I could have made 90% plus in the Qs, or I could have been in this stock to get a negative 10% return. No, this is the company's revenue trend on a trailing 12-month basis, and this is where it's expected to trend. The company has gross margins somewhere in the 70-80% range consistently. They have gross margins somewhere between kind of the 15 and 20% range consistently here. If we look at a trailing 12-month of their earnings per share, this is where we're at right now, and this is where we're expected to go. Free cash flow of this company on a trailing 12-month basis, this is where we're at right now. Is that pretty impressive? You tell me. Doesn't take a rocket scientist, a stock market genius to figure this one out, okay? Operating income of this company on a trailing 12-month basis, boop, 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 boop. My guess is, boop, 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 boop. If we look at the cash, marketable securities versus debt, look at how solid this balance sheet is. Look at how consistent it is, right? So dang consistent. Now, when we look at the forward P of the stock, it's 27. 2-year forward P is under 20. Keep in mind, this is a SaaS company. which means you usually command a much higher valuation. Like SaaS companies usually command forward P's of 30 plus. Okay? Earnings per share growth is expected in current year to be extremely strong. Next year expected to be extremely strong. Revenue growth current year is expected to be around 9%. Next year revenue growth expected to be a little over 9% as well. Trailing 12-month revenue growth was around 7.9%. So we got a good trend going there as well. So are you impressed? If you know anything about stocks, everything I just showed you there should have impressed you. You should be like, dang, it's a pretty freaking impressive company. Like, this looks pretty good, tasty. So what stock is it? It is CRM, Salesforce. A hated chihuahua of a stock, and it is a great buy right now. Now, in regards to stock, if the market got hit, where does the stock go to? If the market got hit, the SP 500, NASDAQ got hit, my guess is a stock would go down to 190 to 200. Worst case scenario I could possibly see for kind of Salesforce as far as stock price going down in the short term if the market got hit hard or something like that, right? We had a fall 2018 drama, right? I got my shares at $243.10. Well, so far I'm up $91.50 on this position, right? Now here's my bull case for CRM Salesforce. I have them do it. Now keep in mind, my bull case might be actually too conservative. Because when I think about if this company's AI products really hit, and I think they are going to hit, Agentforce and whatnot, like there's a lot of potential here. They got an acquisition that we'll be going through that we'll talk about a little bit later on. I mean, 12% revenue growth per year might be low for a bull case for Salesforce, but I'd rather be conservative in my bull case, base case, and bear case. I'd always rather like, So 12%, that puts them at about $62 billion of revenue in 2029. And then doing net income growth of 20%, they should far outstrip their revenue growth when it comes to net income over the next few years, given the cost synergies in the business. So that puts it at about $18 billion in net income. It puts them at net income margins of 29% in 2029, which honestly, Salesforce should get to like 30% plus net income margins before 2030. They should. But once again, I go a little more conservative, even under a bull case. 27 to 32p is very, very fair for a company growing. I mean, honestly, that's undervalued. But once again, I'm going conservative here. You got a SaaS company growing revenues 12% a year, 20% net income growth. You should command easily a PE in the 30s. But I still went a little conservative. I went 27 to 32. That puts the stock over $500 on the low end and around $600 on the high end. Gives me a compound annual growth rate of 20% low end, 25% high end. Base case. Base case is just a fancy way of saying this is what I expect Salesforce to do for their numbers with a little conservativeness in there. I expect them to do 10% revenue growth per year over the next number of years. So, it puts them about $57.6 billion of revenue come 2029. 18% net income growth. Once again, net income growth should far outstrip revenue growth. Additionally, if they do some big share buybacks, that should help the earnings per share as well, because that will take some shares off the market. And Salesforce already announced big buybacks, so do keep that in mind. That could definitely help earnings per share as well. Here we go. Net income margins 29% here. 25 to 30p, very fair for a company growing at these sorts of growth rates in the SaaS space. Gives you a compound annual growth rate on the low end of 16%, high end of 21%. I like this a lot. Bear case for Salesforce. This would be really bad. 6% revenue growth on average per year, 10% net income growth on average per year. This would mean there probably was some colossal, monumental recession at some point in time. Businesses got devastated. 22 to 27p for these sorts of growth rates for a SaaS company. That gives me a compound annual growth rate of 4% on the low end, 10% on the high end. I mean, it's not horrible. Like for a bear case, still getting a compound annual growth rate of 4% to 10%, it's not bad. It's not bad. So, it's pretty attractive. Now, this is something I posted in my private stock group late last night. This is a high-level teaching point here. Salesforce is buying this company for $8 billion called Informatica. You look at the income statement and you say, why the heck would CRM want to do that? My guess is CRM probably believes they would start selling their product to their massive customer base. You got to understand, Salesforce has an incredibly massive customer. Like, it seems like almost every enterprise is a Salesforce customer in some way or capacity. When you look at how many products, their product suite, oh my gosh, it's unbelievable. And build it out to $5 to $10 billion a year in recurring revenue business model. My guess is also CRM would get much of the R&D, support staff, and executives basically out of the company once integrated, which would mean the product/business would just start to generate great margins and great profits. My guess is that $8 billion they pay for this would probably be paid back in 4 to 7 years if all goes well, right? So this company, if we look here, revenues $407 million in the latest quarter, gross profit of about $326 million. So my guess is once the deal's done, which the deal should go through, I would say probably in the next 6 months or so, deal gets done. 26 will probably start to strip out some of the R&D, some of the sales and marketing, because you got to understand Salesforce already has their massive R&D team. So they'll probably just keep the very best of the best that are on the sales and marketing team there, the R&D team and the G&A team. And then they'll get rid of a lot of the executives, which are the big money people, because Salesforce doesn't need them around, just to be quite frank. And then that will be that. And so then what will end up happening here is Salesforce should be able to, once again, sell this to their massive customer base, build the revenues, have the revenues for this product suite to skyrocket over the next 5-10 years. And then additionally, they'll have a super low cost base here, right? Which is going to produce great margins and great profitability. So that's what I see coming there. In Salesforce, this isn't their first rodeo. They do these acquisitions all the time, and they strip out the cost, they grow that product. It's beautiful, okay? Now, how big of a position could I make Salesforce? I'm going to be honest with you guys. I could buy hundreds of thousands of dollars of this stock. I wouldn't mind. Like, if Salesforce was a $1 million position in the public account, I wouldn't mind it. I like this company a lot for the next 5-10 years. I really like it a lot. So, once again, if I had $1 million in the stock, I wouldn't mind it one little bit. I wouldn't mind it one little bit. So, especially if Salesforce remains around here as far as the stock price or goes lower, the best thing for me would be Salesforce goes lower in the short term. When I say short term, I'm really talking over the next 3-4 months. That would be the best case scenario, because I would just load the boat. Like, if Salesforce went down to 230, 220, 210, 200, something like that, oh my gosh, I would just load the boat with Salesforce shares in the public account, probably my other portfolios as well, and just build the position out to quite a great extent, right? And by the way, the CEO of the company, Mark Benioff, dude's a legend, legendary businessman, legendary salesman. If you're an entrepreneur, look up Mark Benioff's story and how he's built Salesforce over time. Unbelievable. That's the type of dude you want leading a company. Benioff, one of the goats of business, certainly of the last 30 years, okay? So I have good news. I have lots of good news for several stocks out there, and we got to get into this in this video here today, okay? Appreciate y'all joining me. Elf Beauty, if there's any Elf shareholders in the house, I have some good news for you guys here today. Elf Beauty closing over $130 a share, up 3.6% here today. I have some good news for Celsius shareholders, some very good news. Obviously, Celsius stock has been red hot now. We're up $146,000 on the stock, up 150% on a relatively new investment. I have some really good news in regards to Celsius. Meta, oh my gosh, could we get any more good news in regards to Meta? Up $994,000 on the stock in the public account. I have some good news if there's anybody out there that owns some Meta shares. So we're going to get into all that at the top of this video here today. After we get done going through that, we're going to react to this video here from the Professor Jeremy Ziegel. Looking forward to sharing my thoughts and opinions on that one. Google McDougal obviously moving huge. Oh man, some good news in regards to Google, and I want to share my opinions on what to do with Google now at this point in time. I posted this on my X page here today. If you ever want to follow me on X, by the way, that's always linked in the description area of all my videos, but I posted this on X today. I say, Google shareholders, what's the plan? Buy more, sell some, sell all, or just hold? What do you think is the best play with Google stock right now? So we'll speak about that in this video here today, and then after I share my opinion perspectives, I want to hear the Wall Streeters' opinions and perspectives. We'll see if they get into a fight. They got the fighting crew up here, so we'll see what happens there. Okay, appreciate y'all for joining me as always. If you haven't already done so and you're new here, please smash a like button. That is what all the OGs do, and I appreciate all the OGs for being here. You guys already know. You don't even have to be told to smash a like button. It's only the new people, okay? For the new people in the back, make sure you hit that like button. I appreciate y'all for being here as always. Additionally, if you want to be subscribed to the channel, you can certainly subscribe. I think we're at, how many subscribers are we at now? 107,000, I believe, here on the reaction channel. So appreciate each and every one of you for being here. If you need access to all my premium courses, access to my private Discord chat, access to see the stocks I'm buying and selling each week in my $3 million plus Fidelity account, access to 1000xstocks.com, you want to become a great investor, all that good stuff, pinned comment down there, click on that, fill out a form. Let's see if we can get you inside my private stock group, okay? Alrighty, guys, so here we go. Good news in regards to ELF. Well, this might not be good news, might look like bad news, but I'll explain why this is good news, okay? So Deutsche Bank came out here in the past 24 hours or so, and they downgraded ELF from a buy to a hold. Now, they also raised their price target, which is interesting because the price target is technically lower than where the stock's trading at right now, but they raised this price target, but yet they downgrade the stock. Interesting. So that's a whole situation, okay? Now, they believe it has limited upside. As far as catalysts, they say continued expansion for ELF and Rode product lines, strong medium-term top line and profit growth opportunities. Overseas growth runway remains intact. True. They say risk factors, valuation concerns, 35 times next 12 months consensus earnings. So basically, this is a call around valuation. The stock's rallied a lot. They say shares have already rallied 25% since early August, reducing upside, they said. They're neutral. Optimism on growth remains, but valuation ceiling tempers conviction. Analyst comments, they say ELF shares have appreciated about 25% since early August, surpassing the $121 price target. As such, we move back to the sidelines today and downgrade the shares to hold, even as our price target rises to $128 on a roll forward in time and continued general optimism around the medium-term top-line profit growth opportunities. We continue to see room for sizable expansion across both the ELF and Rode product lines, particularly overseas. However, at current valuation, nearly 35 times next 12 months consensus earnings and 20 times next 12 months consensus EBITDA, earnings before interest, taxes, depreciation, and amortization, we are held back. Now, the reason this is good news here in regards to ELF, okay, is analysts goes more bearish on, they're not bearish on ELF, right? They're going neutral. They're just like, I'm not bullish, I'm not bearish, we're just in the middle now. The great news about somebody like Deutsche Bank coming out and saying that is twofold. One is, what happened to the stock here today? Up very nicely, closing at $130 plus, which is one of its highest closing prices of this entire year. So basically, investors said, okay, cool, we're buying, right? Now, the other important thing I think about this is it's almost impossible to be bearish on ELF now at this point in time. Now that you know the growth rates are about to skyrocket back up again, right? Now that we have the worst of the tariff fear out of the way, it's nearly impossible to be bearish on ELF. And this stock has a runway to 200 plus again. It's just a question of how long does it take to get there? 6 months, 12 months, or 18 months? That's really the only question. The stock's headed to 200, but does it happen this next 6 months, the next 12 months, or the next 18 months? That's really the only question at this point in time, at least in my opinion, right? It's going to head back to all-time highs, which all-time highs for ELF were around I think they're around 210, 212, something like that, right? We're headed back there. So ELF has a lot of, I guess you can say, really exciting times ahead, and this shows that analysts can come out and, they're like, they kind of brush it off, okay? Now, what about Celsius? What's the good news in regards to Celsius? Wow. PepsiCo and Celsius confirmed strengthening of their strategic partnership on Friday. Under the new agreement, Celsius, an Alani Nu brand, will be distributed through PepsiCo, U.S. and Canadian distribution network to greatly expand the rising brand's retail presence and reach new demographics. Okay, that in itself is huge. Okay, Alani is a brand that just got acquired by Celsius not very long ago. Alani has unbelievable growth. And now Alani's going to get into the PepsiCo distribution. Now, what happened to Celsius when they got into the Pepsi distribution is Celsius's revenue took off like a rocket ship. Then about a year to a year and a half after that deal went through, then Celsius kind of had to come down of the growth rates. Now, my opinion on this is PepsiCo won't over order like they did on Celsius. So I don't think we'll have to deal with it as big of a problem. But the moral of the story is here, folks. Alani's revenue growth is going to be outstanding for a long time. And when I say a long time, I'm talking really like at least like the next 2 years, because Alani's already a brand that's got strong growth without the Pepsi deal. Now you're going to put the Pepsi deal under it, and a lot of this distribution will take place in 26. Some will take place here in 25, but a lot of it's going to take place next year in 26 as store resets come and all that sort of stuff happens. And so just understand, Celsius's revenue growth is going to be incredibly strong for quite a while. Like maybe we have some sort of come down in 27 or 28. That's a potential, but it's going to be a while in regards to that. Celsius's revenue growth rates in 2026, folks. I mean, whoa. Like we're going to be talking about I think there's going to be some quarters that revenue growth is up well over 100%. Because you're going to have easy comps. Celsius numbers should be up on a year-over-year basis in 26. You have the Alani deal, and now you have the next part we're getting into. Simultaneously, Celsius has acquired U.S. and Canadian rights to Rockstar Energy brand from PepsiCo, which will add classic energy drink offering to the company's portfolio and potentially appeal to a wider consumer base. PepsiCo retains ownership of Rockstar Energy internationally and will continue to distribute it domestically for Celsius Holdings, which is a very interesting deal that, they're still going to retain their ownership of Rockstar internationally, right? So intriguing. Now, Rockstar, what I can tell you about that brand is that brand was really a direct competitor against Monster. Traditionally, I can also tell you when I worked at Quick Trip and I was a lot more into the nitty gritty and I was able to see the numbers of, what stores were selling how much and all those sorts of things. Rockstar was always a strong number 3 player. But keep in mind, this is like 10 plus years ago. I worked at Quick Trip, okay? And I was a manager and whatnot, and I got to see all the numbers that, every single SKU was selling in the stores and things like that, okay? So it's been a long time. But back then, Rockstar was a really strong number 3. Now, PepsiCo bought Rockstar for a ridiculous sum of money a few years ago. I think it was back in I want to say 2020. And it looks like PepsiCo kind of crashed and burned it. They don't, PepsiCo's got so many brands, so much going on. It looks like they just kind of failed Rockstar, and Rockstar has been in kind of a tougher place. So maybe Celsius will be able to get things rolling there, right? As part of the transaction, PepsiCo has invested $585 million in newly issued Celsius convertible preferred stock and increased its stake to approximately 11% on a converted basis. PepsiCo will also appoint an additional director to Celsius's board. Going forward, Celsius Holdings will take on key strategic role of energy lead for PepsiCo in the U.S., overseeing strategy for Celsius, Alani Nu, Rockstar, while PepsiCo handles distribution. Now, this is huge, folks, okay? If we want to call the original investment like a teaser investment of PepsiCo and Celsius getting into bed, this is we're married. This is marriage at this point in time for PepsiCo and Celsius. And what this means for Celsius is now they have, the number 2 most important drink company in the world fully aligned with them. Now that PepsiCo has a 10% plus ownership stake of Celsius. And now, no longer is PepsiCo a competitor to Celsius. Now that, Celsius is going to have Rockstar Energy in the United States and Canada. So there's no reason for PepsiCo to even try to compete now. They just want to try to grow Celsius as big as possible so they can grow that ownership stake in Celsius as big as possible. I mean, I'm sure PepsiCo would love it if, we could talk about Celsius someday being a $50 billion or $100 billion market cap. That'd be a great thing. Because if you run the math on that, and they've got a little over 10%, 11% of, the stock, I mean, we could be talking about PepsiCo's stake in Celsius could end up being, if it was a $50 billion company, we're talking about, a $5 billion plus stake at that point in time on a relatively small investment, right? Additionally, we could talk about if Celsius builds their business over the, I'm sure in the 2030s, Celsius will start paying some sort of big dividend to all its shareholders. That's my hunch on that. Like they're just going to be focused on growth here for the remainder of the 2020s. 2030s, we'll be talking about this as a dividend company. And then if you think about PepsiCo having 11% of the shares, well, shoot, there's a whole lot of dividend money PepsiCo could start bringing in, right? So that's always a potential there. And I mean, to think about this even deeper, as Celsius's cash flows build up as the years go on, my guess is Celsius will also probably buy back shares. So if PepsiCo has 11% ownership now, and Celsius buys back tons of shares over the next 5-10 years, they're not going to buy back any meaningful shares in the short term because they're so focused on ridiculous growth. But I wouldn't be surprised if all of a sudden 2028, 2029, 2030, you start hearing about big share buybacks. Well, PepsiCo's ownership, if PepsiCo doesn't sell and Celsius starts a massive buyback, that ownership stake could go to 12%, 15%, 20% for Pepsi over the long term, which, once again, if Celsius becomes a drink giant, a $50 billion or $100 billion market cap, my gosh. And the dividends, we could be talking about Celsius pays out at that particular time. And then for Pepsi, you also have the potential of maybe you sell off the position long term, right? Like, I don't know, we'll see what happens there, but I think it makes sense from PepsiCo's perspective. And I think really truly the one that gets the best deal of it. And obviously PepsiCo gets to make money off the distribution as well. So do keep that in mind. But I honestly think the one that's getting if you had to say who's the absolute biggest winner, I honestly think Celsius is even a bigger winner here than PepsiCo. Like both sides should win in this situation, but I think Celsius is the bigger winner. Winner, chicken dinner. Stepping into the role of PepsiCo's strategic energy drink captain in the U.S. is expected to be a pivotal milestone in our journey to shape the future of modern energy and grow our brands with leading beverage distribution system, stated John Findlay, the CEO of Celsius. This agreement marks the next step in PepsiCo's reshaping its brand portfolio to position us for the long term, said the CEO of PepsiCo's Beverage US. Energy is an important growth category, and we believe this move with our partner Celsius creates meaningful multi-brand energy portfolio that better positions us to serve the customer needs, right? You got to understand here, okay, PepsiCo and Coca-Cola, they both failed miserably. Not a lot of people know this. Coca-Cola and Pepsi both did what? They both tried to be successful in the energy drink category, and they both failed miserably. They fell flat on their face. They tried and they tried and they tried for the last 20 years, and they could not do it. So finally, Coca-Cola years ago threw in the cards and said, "The hell with this. Let's just buy an ownership stake in Monster, MNST." An old stock of mine, right? I owned it before it was even called Monster Corporation. I owned it way back when it was called Hanson's Natural Beverage. That's how OG I was as an investor in that company back in the day. And that's been incredibly successful for Coca-Cola and successful for Monster as well. And so PepsiCo realizes we failed. We failed miserably. We've tried to launch so many brands, they all failed. We try to Mountain Dew Energy, all this different stuff. We try to buy Rockstar. We can't do it. And so they realized, let's let the next energy drink giant go ahead and do it for us. Let's take an ownership stake in them. That way we capture the success of it. Because you got to be really into the weeds to really be successful at this. And PepsiCo and Coca-Cola aren't. Those companies understand the soda game, but they do not understand energy drinks. They don't understand the marketing behind that. You got to really be into it, man. You got to understand social media on a high level and things like that, right? So now in regards to market share for Rockstar, it looks like it's around a 2% market share, somewhere around there roughly, which if you combine Celsius, Alani, and Rockstar, they should end up having about 20% market share, which is going to be a very strong combined company. Now, keep in mind, as Alani gets more distribution, right, we could be talking about, well over 20% market share of this total company if we talk about it a year or two in advance. Additionally, if Celsius can revive the Rockstar brand, hey, then we're really talking. Then we could be talking about maybe market share pushes closer to 25%. That would be pretty darn exciting, right? So, yeah, Celsius shareholders, I mean, it's a fun ride. It's a fun stock. And I mean, the growth rates is just going to be astronomical. I hope everybody's ready to get their flapjacks flipped on those growth rates. And I mean, after seeing this deal go through, where do I think the stock's headed? Listen, this stock's taking out all-time highs. And I think it's taking out all-time highs in the next, probably 9 months. And I think that probably regardless of where the stock market goes. Now, am I going to play call options on Celsius in the short term? And, no. But, I really think, Celsius is probably going to boom over this next 9 months. As people start to see these numbers roll through, oh my gosh. You got to understand, people are investing in companies like ELF and Celsius for what? The revenue growth. That's why they're in those stocks, right? And there will be a day, and it's in the 2030s, when ELF and Celsius, it's not about the revenue growth, it's about the margins, it's about the profitability. But for right now, people just want to grow that top line. That's why you invest into an ELF, that's why you invest into Celsius, and both those companies are about to come through and just absolutely smash it. Whew. So get ready, folks. Fun times ahead, and Celsius will be at new all-time highs before you know it, okay? Alrighty, next one up here, Meta. Meta has some really good news, okay? So everybody has seen, obviously, the whole Google situation, right? And we'll talk more about the Google situation in a moment, but this is a huge deal for Meta. And the reason being is there was a fear that maybe the government could try to break up Facebook from Instagram, from WhatsApp, things like that. After this, there's basically no fear for the stock now at this point in time. Any of that, in my opinion, that was a rational fear, but it was fear out there. Oh, maybe they're going to force, Meta and Instagram to break up, or them to break up WhatsApp from it. Nah, it's not happening, okay? And so this stock has a clear runway to $1,000 plus, in my opinion. I think analyst EPS estimates are way too low on this stock. I looked at analyst estimates for what they have for this next year, and I'm like, it doesn't make any sense to me. It's not like Meta's going through some insane hiring spree right now. They're spending a ton on CapEx, but that's not hitting their net income and their EPS. So I think analysts are way too low in their EPS and net income expectations for Meta here. And I think the stock's running to $1,000. And my only question is, does Meta hit 1,000 this year, or does it hit next year? My question isn't, does it hit 1,000? It's is it going to hit this year, or is it going to hit next year? That's really the only question in regards to Meta. So yeah, this news, and it's also good news for other big tech as well, but specifically Meta, because that was one that was getting brought up in this whole situation, okay? Alrighty, time to get in the Professor Jeremy Ziegel.
And Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. And Jeremy, we're down on this first trading day of September.
Jeremy.
Probably because of questions about the tariffs, but I don't know. We're also at relatively high levels. How are you feeling about things right now?
Yeah, and probably because of September.
Right.
being historically really the worst month of the year. Listen, certainly we could have a pullback. I mean, I still think the bull trends are intact. I know you guys mentioned the Wall Street Journal article this morning about all-time high, so I took it out and read it, and it said, oh, yeah, it's all-time highs relative to sales. Well, I thought we, value stocks on earnings, not sales. And we're way, below any all-time high in terms of earnings. Not that it's not an expensive market, but once you take out, and even that article admitted, once you take out the Mag 7, we're only, slightly above a longer-term medium. So I still think this bull run has a place to go. Revisions are still upward. I mean, there's a lot of things that can derail it. I mean, the tariff development is very interesting, because I think it's going to go to the Supreme Court, and I think the Supreme Court's going to throw it back to Congress and say, have the Republican Congress say okay, and then it'll go through, and that's going to be very interesting politics, I think, in the second half of this year.
It's just the Senate.
The death of bull markets has been greatly exaggerated. The thing you got to understand about the end of a bull market, and how do you actually get a bear market to start? And, bear market, people categorize it different ways. The bottom line is a market that the overall trend is down for at least 6+ months, right? How do you get that to happen? I'll tell you how. Something monumental has to happen. It can't be a small, this whole, no, has to be huge. So for instance, how did you break the bull trend back in '07? We had the starting of the great financial crisis, right? The banking system nearly collapses, massive economy, housing market crash, all those sorts of things. Okay, boom, you got to break a bull trend. Then we had a massive bull trend again for a long time. Now we had corrections along the way, some little short-term crashes, things like that, but nothing crazy. We never really had a bear market from basically coming out of that great financial crisis all the way to 2020. How did you break that bull trend? A once in 100-year health event. Boom. Trend broken, right? Bear market. All right. Next up. Get back into a bull trend. How do you break that bull trend? 2022. Inflation at the highest rate it's been at in decades and decades and decades. So it has to be something comes out of nowhere that people didn't really see coming, and it really creates massive ripple effects across the financial markets, across the economy, across consumers, things like that. It can't be something that's known. So for instance, like people look at like the national debt and they're like, oh, that's going to be like everybody and their grandma's known about the national debt for like 50 years now, 60 years, 70 years. They've been talking about that for the longest time. I think the national debt is like a new subject. No, it's not new. It's higher than it's ever been. And guess what? It's going to be higher than it's ever been next year and 10 years and 5 years and 15 years from now. Like, that's just the way it is. So it has to be something comes out of nowhere and it creates a overall big bear trend. And that's how you break a bull trend. And really cause a true like bear market that downtrends significantly for quite some time.
I think that's going to be a really interesting sort of development.
Yeah, I mean, he has control. The party has control of the Senate, of the Congress. We'll see if they would choose to fight him on that or whether they'd say, okay, we go along with what we've seen to this point. But I want to go back to what you just said, this idea that we're at the highest level if you divide by sales. I mean, we mock people when they look at sales. We say that's not the real number. You're right. If we're looking at earnings, that seems like the much more important number to bear out.
And the biggest companies you're talking about, the Mag 7, are the richest in terms of price to sales, probably, too, because of all the potential.
And it's because the margins of those companies are so high. Margins of digital tech companies have always been the highest. So if they're predominant, you're going to get a result such as this. And I think that's built into tech. Tech has very, very high margins because of the way accounting goes and the way globalization and how you can replicate with no cost. All you need is those customers to come. So it's a very different sort of a thing than looking back at a steel company or an auto company. And to put them all together, I think gives a misleading look at the market.
So you're feeling pretty good about things, even though you look at the calendar and see it's September.
Yeah, and again, I wouldn't be surprised. And short-run forecasting is hard, but the upward revision of earnings, after it took the hit in April, and we still have to see. I mean, there's a big dispersion. I think one of the biggest dispersions I've seen in GDP for this quarter. I mean, it's true that the Atlanta Fed is looking like 3.5, but sort of shocked me. I think Goldman's still looking at 1.5. J.P. Morgan is sort of in the middle at 2.5, and I've never seen such a dispersion. We're more than 2/3 of the way through the quarter, outside of recession periods, which of course are very different. So I think there's still a lot of questions. Not all those price increases are yet recorded. What is going to happen the second half of the year? I think that's really the biggest question. And that, of course, is still linked with the tariff question of the legality and how it's going to flow through to the consumer. So
obviously a lot of questions, but you're still feeling pretty good. And I think we'll take it at that.
I'm still positive on the market at this time. Of course, any sort of developments could come that could change that, but what I see is still constructive, very constructive.
Alrighty, so next up here, Google McDougal. So I posted this on my X page once again. That's always linked in the description if you guys ever want to follow me on X. But Google, obviously big move here today, up significantly and that stock has gone up quite a bit very rapidly for me because that was a buy back April 23rd. So that was 5 months ago or so, or somewhere around there roughly, right? And, You know, to already be sitting on a 47% gain is pretty significant on a stock like Google. But my feeling on Google is I think it's a hold right now. And I think it's also a buy. Like I won't buy any more in the public account, but I wouldn't mind buying some more in my Patreon portfolio to build that position bigger. And the reason being is you look even after today, forward P, let's call it Do 22. If you compare it versus its peers, which you're going to compare somebody like Google against Apple and against Meta, why doesn't it deserve a 22? Why doesn't it deserve actually a much higher number than that? If you look at Apple trades 31. Meta trades around 26. Now you say Meta's got likely better revenue growth going forward, and it's had better revenue growth in the past. So Meta likely deserves a premium over Google. Apple trades at 31, and Apple actually has significantly lower revenue growth than Google McDougal. And I think also, I just think like Google's more well positioned for the next 10, 20 years than Apple is. So if anything, I think Google should get a rating higher than Apple. Or you could make a case that maybe Apple should come down a bit and Google should go up some. So I view the stock as either a buy or a hold right now. I actually don't think it's a sell. I don't think it's, to sell Google now, it just doesn't make a lot of sense to me, at least in my personal opinion. But let's hear from the Wall Streeters on what they have to say.
39.5% since the so-called Eddie Q sell-off. That was May 7th. You said everybody pipe down, relax. The stock is just fine. The company's just fine. Now what do you say, my friend?
Now I say it's still undervalued, and a meaningful overhang has been taken out of the name. You never know what's going to happen with these things. The judge can go any way they want to. But the idea that we would be talking in May, as you referred to, Scott, about competition eating Google's lunch, and at the same time that this judge would rule that there's a monopolistic practice here at Google, well, that was the ruling, but that the punishment would be draconian to reflect that monopoly, that was completely incongruous. You can't hold those two thoughts together. So although it was not a fait accompli, I'm very delighted. This is the news I expected. And now the overhang's gone. And what you've got is a stock that's trading at the low 20s. I think it's about 22 times forward earnings. You compare that to the rest of the Mag 7. And like the rest of the Mag 7, this is going to be an AI beneficiary. Yes, there is competition. But this is Google, a multi-trillion-dollar company that has been at AI for a long, long time. People don't remember that, but it's been at this for decades, and they have a viable product. That's showing up, by the way, in their quarterly results, which I expect will again be the case in the quarter to come.
You catch a fair amount of grief from the bench, and now you get some love. Because, you told people to just chill, relax, don't make such a huge deal of the Eddie Q thing, even though it's not like it's an insignificant point that he was making. It's just the stock's up a lot, and this is a big deal. 9 target hikes at least that we could find today. What do you think about this? I'd like Jimmy declared this, even with the gain, still undervalued. Well, if you look at mega cap valuations, it certainly has a lower forward PE than the others. Did we make that up? Let's show it if we have that. Because Amazon's like at 32 plus times, as is Microsoft. Alphabet's at 21.3 times. Maybe it's a little more now because of the gain that you're getting in the stock today, but nonetheless, does this start to close? Does this closure, if you consider it that, close the gap from a valuation standpoint between Alphabet and some of these other names?
Jimmy nailed it. Yeah, this is removing a significant obstacle, and I agree with you. I believe there's further upside potential here. When you look at the sum of the parts, you look at the various businesses and the valuation here, one can think about this company trading with a market cap exceeding $3 trillion very easily. Just thinking about the combination of a very powerful Waymo business, YouTube TV, the cloud business we know is doing well. And when you think about the valuation of OpenAI, how that has grown so dramatically to over $500 billion, what does that mean now for the valuation of Gemini and for Google Cloud itself? So it lifts the obstacle. It absolutely is a clearing event. And
the most compelling thing about Google, right? You just spoke about OpenAI raised, I think it was today, at like a $500 billion market cap. The most interesting thing is Google has only seen the bad side of AI so far in regards to the stock price. Everybody's always like, oh, so scared, like it's going to be disrupted, blah, 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 blah. So all they've had is negative effects so far to the valuation in regards to AI. Meanwhile, they're likely going to end up being a big beneficiary of AI. So what happens when we flip from this negative stance into more of a neutral stance and then into a bullish stance around Google? And what's going to happen to its valuation then? Think about that for a moment. I think that's very, very meaningful.
I also think it benefits the entirety of the AI halo because it gives now Google the opportunity to go out and actually spend more. Google doesn't have to sit back and concern itself with these antitrust fights.
I'll tell you what, this is an antitrust issue, quite obviously. It doesn't eliminate the broader question, like the one that Eddie Q raised in the courtroom, of whether these large language models and these co-pilots and generative AI deals are going to cut into the monopoly that they all but had in search. This does nothing to address that, does it?
That's fair, but it does allow them the opportunity for a very cash-rich company to go out and actually spend and defend against that loss of market share that potentially is coming. So
you're pointing out something very important. This is a huge company. The huge companies in any industries win by virtue of their size, by virtue of the resources, whether it's financial, as you're pointing out, or as intellectual, as I was pointing out before. I think this is very important. This is why I was so calm on the Eddie Q comments. It's a $2 trillion company. Now, I was surprised that it became a battleground stock. This was one of the more calm moments that I've had when defending a stock because of the size, which you're speaking to, Joe.
Twice you own it too, obviously. Do you think it's a value? You start to close the valuation gap now?
I think you can close it somewhat more, but I don't think you'll close it completely. This stock is always sold at a discount, or generally. I don't want to say always, because that's just too strong a term, but it's generally sold at a discount over the last 5-10 years to some of the others, including Amazon. But here's what it also does, which I'm not aware that most are talking about. Gmail, Google Mail, is the dominant player in mail in the U.S., in email. Without the microscope on them for anti-competitive activity, they can do what Netflix has been doing. Now, they've raised prices somewhat, but they can raise prices more now without the glare of antitrust proceedings on them. So I think there are multiple levers they can pull to drive revenue, to drive earnings, and I'd look forward to them doing that. I've thought about this quite a bit, is that how much of that headwind from the antitrust proceeding was still in play. I mean, the stocks recovered from 165 to 200 before this. So you got to believe some of it was discounted. Now, when it was at 165, everybody
crushed. Look at the move in the stock today. It would say that
I'd say some of it has been discounted.
Maybe didn't expect this outcome.
No, clearly it didn't. But you still have the headwind of search share and of giving up some of their data.
I know, but the whole point is that maybe all of that was overblown.
No, and I think it was by today. But what I'm saying is that's the reason why it won't recover, or it won't go to the extent on a multiple basis that you see Meta and Amazon and others at. So that's my point. You'll continue to see it move up, and I think the headwind of losing position search is overstated, because they'll still be the one to dominate advertising just because of their share they'll have. So I like it. I'm staying there. I debate about buying some more when the announcement hit, but I choose to wait for it to pull back a little bit, because I think that's what will happen.
Liz, I'll make this quick. Meta is, you mentioned it, it's the direct comparable here in terms of what the stock does next. 2 years ago, Meta was trading at a high teens forward multiple. Many people, and I think it was you, Steve, it wasn't me, bought the stock at that point in time and have enjoyed both a multiple expansion and earnings growth. And that's exactly what I think you're going to see with Google over the next year to 2 years.
Aren't you talking about, you're talking about a stock move, but you're talking about apples and oranges in terms of issues. issues.
You're correct. I'm talking about a stock move in terms of what to expect. You're absolutely. There are some similarities. I mean, Steve was just bringing up email. Well, let me extend this because Steve was just bringing up email. It's only one piston in the engine. There is YouTube, which I would say is a direct comparable to what's going on at Facebook. But yes, Scott, there was the year of building out the metaverse, followed by the year of efficiency. I'll grant you. I'm simply saying from a stock point of view, absolutely Meta is the comparable in my mind.
So Liz, you look at this trade lately, which has been somewhat in question as you head into a new month. This is just what the doctor ordered. If you can remove some sort of regulatory and antitrust overhang over the space, what's that do?
I mean, it certainly helps. It removes one of the skepticisms that people might have had about current valuation levels. I think we're talking about some idiosyncratic issues with one stock, though. But when you look at the trade itself, if we're just talking about mega cap tech, or even if we're just talking about semiconductors and everything that has been under pressure over the last, call it 5 trading days or so, you can't remove the fact that what's happening in the rest of the market, especially with yields, is probably pressuring them as well. And I talk about the relationship between assets a lot. This is a relationship that I think right now is intact. You've got long-term yields rising and long-duration stocks under pressure. That makes sense. This could be a period of time where we're just sort of normalizing to a level of yields that needs to be more rational given the environment, a level of inflation that's perhaps digested by the economy.
Listen, these big techs are benefiting massively by what? By what's going on in the yield market right now, right? We know these big tech companies are loaded to the sky with cash, which if you're able to buy treasuries with all that cash, right, you're able to earn a very nice yield there. We also know many of these big techs have very low debt levels or no debt, some of them, right? Which means, they're not really affected by higher interest rates. Higher interest rates are actually a net huge benefit for these companies. Where the same can't be said for all companies out there, right? So that's just a little factor to keep in mind in regards to this subject, okay? Appreciate everybody joining me as always. Thanks so much for being here. For those of you that are looking to get access to my entire library of premium courses, like Become a Master of Stock Market course, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, my Valuation Mastery, teaching you how to properly value stocks, right? If you're looking to access exclusive weekly videos from me, my private account or my public account, which is a $3 million plus fidelity account, as well as thousandxstocks.com if you want access to all that good stuff. What a past year it has been for the public account. I mean, just an absolute skyrocket ride into a straight massive downtrend, into a skyrocket ride. And now we're in this time period where things are just kind of chilling out in the public account. And we're trying to figure out, are we setting up for a breakout here up to the $4 million plus level, or are we headed down, let's call it to the low threes? And so I want to speak in this video about where we're headed next, in my opinion, in regards to that. Google McDougal stock is exploding 7% after hours here on some news that came out. Obviously, this is a stock I do own in the public account. I own 444 shares. What's my opinion on this, right? As of tomorrow, we should be up way over 40% on this position in a pretty quick amount of time. So what do I do with it now? Do I sell it off? Do I just hold? Do I buy more shares? What about in the Patreon portfolio? The Patreon portfolio, I bought this stock week after week after week after week. Literally every single week I'm buying Google stock in the Patreon portfolio. So what happens now? Okay. Now, additionally, I want to talk about, I spent $30,000 plus on several stocks here today. We're going to talk about what stocks I bought, why I bought those stocks. I hope you guys enjoyed today's video. I hope you appreciate it. Only one thing I need from you guys: please hit the like button on this video. I hope you can do that for me. It takes like a second. Like, you could do it right now. All you have to do is hit the little thumbs up icon. That's all I need from you. Okay. I appreciate every single person that does that. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe. We are now over 880,000 subscribers here on the main channel. So I appreciate y'all for being here. Pin comment down there today if you're looking to access all of my library or premium courses. That will be the pinned comment down there. You also get access to my private Discord chat, access to thousandxstocks.com, access to see the stocks I'm buying and selling in my $3 million plus fidelity account, all that good stuff. Pin comment down there. That will be to apply to join my private stock group, private wealth group, thousandxstocks.com, and we'll send you your Steel membership cards in the mail to your house once you join us in there. Okay. Alrighty, guys, let's get rolling. So where's the public account headed next? Well, here's my opinion. If we look at the public account over the past 3 years, right, it reached that bottom, the fourth quarter of 2022. And ever since then, I mean, yeah, we've had pullbacks, we've had corrections, blah, blah, blah. At the end of the day, the trend is higher, right? So if we're going to have this trend end, we got to really have it end. When I say really have it end, I'm talking like a year-long type bear market, right? Now, when you look at the stock market, a lot of people are very scared of the stock market right now. And the reason being is the stock market is near all-time highs right now, right? And so it's always an interesting time when the market's near all-time highs, because you get two groups of folks to be interested in the market. One is people that are saying, oh, it's at all-time highs, it needs to crash. The other is people that have never bought stocks before get really excited when it's at all-time highs. It's a weird kind of mix that happens there, okay? Now, first off, what is most common when you hit all-time highs in the market? You hit more all-time highs in the market. It's not like, I wish it was as easy as like, oh, market hits a new all-time high and then it crashes. No, if you just look at some massive chart, you think that, right? Because you're like, oh, right there it reached an all-time high and then it crashed. And right there it reached an all-time high and then it crashed. And so now we're at an all-time high, that means it's going to crash. What about right here was an all-time high? Right here was an all-time high. Right here was an all-time high, all-time high, all-time high, all-time high. And then finally it crashes, right? So could the market crash now? Okay. Could, or we could go up here, and then it crashes, right? So that's just something to kind of keep in mind there. Now, on the surface level, if you just look at the indexes, the NASDAQ, the S&P 500, you think, oh man, the market is such a boom. Like, it's incredible, right? But there's a message I sent to my private stock group today, and I put this in the breadcrumbs tab because I thought it was pretty interesting perspective I might have on a subject like this, right? Somebody that looks deeper into the market than just like the index level. I said, are we in a booming market or a bust market? I think it's a fair question. Look at the indexes and you will think it's a booming market. There's no debating that. Look at the NASDAQ, look at the S&P 500. You'd be like, oh, this market's booming. This is a great market, right? I said, what about the fact that big alcohol companies are 40% plus off their 10-year highs? Companies like Sam, companies like Constellation Brands. So what about apparel companies like Nike and Lululemon that are 50% plus off their 10-year highs? What about companies like Salesforce and Adobe that are down 25% off their 10-year highs? And I'm picking like brand name, like everybody knows these companies. Like I don't need to explain what these companies do, right? So companies like UPS and Whirlpool down 50% plus from their 10-year highs. By the way, a company like, I just thought of like Constellation Brands might be one of the only companies here that people might be like, what company is that? Look them up if you want. They own so many of the biggest liquor brands in the world. It's insane. Like once you look into the company, you'll be like, oh yeah, I know that liquor, okay? Companies like UPS and Whirlpool down 50% plus from their 10-year highs. Companies like Wynn Resorts, Las Vegas Sands, MGM down 25% plus from 10-year highs. Obviously, Jack Jackson stocks have all gone bankrupt or they're down 70% plus from 10-year highs. Luxury king stock like LVMH, the king of luxury, down 40% plus from its 10-year high. Tesla stocks have been dead for the past 4 years. Small cap stocks have been dead for 4 years now. Interesting times. So when you look at it like that, you could make a very strong argument that we're not in actually a booming market, right? The market, you can make an argument that isn't that great. Because if you were really in a booming market, what would you see? Let me ask you this. If you were really in a booming economy, a booming stock market, let me ask you this question. Would all the biggest alcohol companies be 40% plus off their highs? Would Nike and Lululemon be 50% plus off their highs? Would companies like Salesforce and Adobe be 25% plus off their highs? Would companies like UPS and Whirlpool be down 50% plus off their highs? Would these resort companies be 25% plus off their highs, right? Would LVMH, the king of luxury, the one that owns the best, most important luxury brands in the world, would that company be down 40% plus from its highs? Would small cap stocks be dead for years and years and years? I don't know about that. And so when you look at it from that perspective, you could say, you know what? Maybe we have more upside ahead for the market and for stocks in general, right? Maybe this isn't the end of the road. And that's a strong argument to be made because we know the other argument that can be made, right? Stocks are at high valuations in regards to the top of the market, some people feel like, right? And therefore, that's going to bring the whole thing crashing down. The way I also got to look at this is long-term versus short-term. Because at the end of the day, like, I want $4 million plus in that public account, man. I cannot wait for it to hit $4 million plus. But with that being said, I cannot get caught up in that $4 million number. I want it so bad. I really cannot wait for the public account to hit 4 million, but I can't get caught up in start making short-term moves to try to I got to hit 4 million this year. I got to hit $4 million. My opinion is I probably hit $4 million in the public account this year. If I don't, I don't. It's okay. If the public account ended this year at $3 million, right? It's fine. I think it's part of the process. As a long-term investor, you just got to ride the roller coaster, right? At the end of the day, listen, 3 years ago, in the fourth quarter of 2022, public account was $1 million. And it's 3.8 million or whatever it is right now. Do I want 4? Yes, I would love a 4. And then we're taking out 5. But at the same time, I cannot control what the stock market does. You cannot control what the stock market does. If the stock market wants to have a correction, like 2018, we have a correction. If the market wants to crash, it's going to crash. If it wants to go up higher, it's going to go up higher. We cannot control that. What we can control is our decision making in regards to our portfolios, the stocks we buy, and are we trying to make short-term decisions to, boost our ego? And we got to stay away from that. And so my guess is public account goes to 4 million plus this year. I want it to go to 4 million plus this year. If it doesn't, that's fine. That's fine, man. It is what it is. We'll be all right, okay? And so that's a way to kind of think about that, folks, okay? Google McDougal. What the heck is going on here? Stock popping 7% plus after hours. And what am I going to do with the stock now at this point in time? Well, here's what happened. Google shares, Alphabet shares, popped 7% plus in extended trading as investors celebrated what they viewed as minimal consequences from a historic defeat last year in a landmark antitrust case. Last year, Google was found to hold an illegal monopoly in its core market of internet search. U.S. District Judge Amit ruled against the most severe consequences that were proposed by the Department of Justice, DOJ, including the forced sale of Google's Chrome browser, which provides data that helps advertising businesses deliver targeted ads. Google will not be required to divest Chrome, nor will the court include a contingent divestiture of Android operating system in its final judgment. Plaintiffs overreached in seeking forced divestiture, I can never pronounce that word right, I apologize, okay, of these key assets. The moral of the story is here, Google's not going to have to get rid of Chrome. They're not going to have to get rid of Android. Is this a surprise to me? No, it's not a surprise to me at all. This was to be expected. I'm surprised anybody's, surprised about this. Been the stock popping huge. I can't believe people thought they were going to be forced to sell Chrome. They're going to be forced to sell Android and get rid of all this stuff. I'm no, come on, man. I don't think enough people understand the legal system, how these things work. I don't think they understand what a true monopoly is. People think if you have a lot of market share, that means you have a monopoly. No. I remember even in college, in some very early business courses learning what a monopoly was. Maybe that was business and law. I learned that. Yeah, I think I took a course in business and law, either freshman year or sophomore year of college, right? Before I dropped out junior year. And even then I learned what a monopoly was. Because just hearing about the term, a company is a monopoly, I thought that meant you have huge market share, so therefore you're a monopoly. No. That's not how it works at all. Look up the definition of what an actual monopoly is, and then you realize, oh, wait a minute, just because you have a lot of market share does not mean that. You have to do all these different practices and, illegal things to essentially put you in that sort of position. So at the end of the day, Google has massive market share. We know that, but it's not a monopoly. And so, somebody that took freshman year, sophomore year college course realized, it's not actually a monopoly. And it's crazy. It's crazy. You would think the stock market, you would think investors would be intelligent enough to know very simple business law. This is, once again, this is something I learned in community college, either freshman year or sophomore year, and the stock market doesn't realize it. The stock market, it's just crazy. You think investors would be they're so intelligent. No. Like, it's unbelievable to me. It's unbelievable, man. So the question is, what do I do now with my Google McDougal shares, 444 shares? You know, public count, up $24,000 on those. I'll let those ride. I do not have ambition to buy more Google shares in the public account. I feel good with where I'm at. Remember, the public account, what is the biggest position in the public account? It's Meta. Not only is the biggest position in the public account, it's by a mile the biggest position, right? There's $1 million plus position for me in the public account. So Google's a lot like Meta, right? Obviously, they have different services and platforms that they're dominant on, but at the end of the day, like, huge advertising business at Google, huge advertising business Meta. Meta and Google, they dominate advertising in the world, right? And so owning Google is kind of like owning a Meta. It's just, you know, the only reason I bought Google, you know, in that dip was just people were being absolutely so irrational with the stock. And I'm like, this stock deserves to be at least 50% higher than where it's trading at right now. And I'm like, you're going to give me arguably one of the safest business models with one of the best income statements, balance sheets, cash flows in the world? That should be trading at least 50% higher now. Not like, oh, it's going to go up 50% over the next 3 years. No, it should be trading 50% higher from the day I bought it. Right? And we're going to see that play out here very soon because we'll be up 50% on it. I'm like, you give me that opportunity, I'm going to take it. So I'm not going to buy more shares in the public account because it's already so overexposed to advertising, right? No, in the Patreon portfolio, here's the deal. I could easily continue to buy Google stock. Like, I probably continue to buy Google stock because you got to understand, I do own Meta in the Patreon portfolio, but it's a really small position. And the reason being is, you know, with the Patreon portfolio, the first year I was only allowed to deposit $150 a week. And then we changed it to now I'm allowed to deposit $250 a week. How much is Meta stock? Meta stock's like 700 something. So I can't even buy more Meta shares, you know, over the years, even though it's always been a great deal. So Meta's a really small position in there that I got when I first started the Patreon portfolio. And now I can't afford to buy more shares. So Google, I would love to continue to build this one. And then I can probably hold Meta and Google in there as kind of a tandem play. And then if you add those up together, they'll be like a big position. But if you add them up separately, they're not a big position. But when it comes to Google here, like, it's at 24p. Okay, it's up 7-8% tomorrow, whatever. Big deal. What's it going to put it at? A 21 forward P? Like, it's still a deal. So the bottom line is I got to keep buying Google McDougal in the Patreon portfolio. And when do I stop buying Google? I would say 275 and over. I would stop buying Google essentially. That would put the stock at like a 25 plus forward P, somewhere around there roughly, right? Which at that point in time, I'd be good on Google. And that does not mean Google's a sell at 275 or 280. That just means I stop buying. I'm like, I'm good. I'm good with what I have now at this point in time. So yeah, there's still quite a ways to keep buying the stock. It's not like, oh, it goes up 7% tomorrow. That's it. The move in Google's done. Like, no, we got further to go here, right? I think this also importantly, I think this sets a tone that maybe the government isn't going to be anti-big business, because there was a worry, especially with Linda Khan at the helm for the last few years. There's just a lot of fear around, the government's going to go after big business. And I think since what happened here, because Google was the one that, you know, if you look at the Trump administration, the big tech I think they viewed least favorable was Google, right? And so the fact that a ruling like this comes out, I think it gives more confidence that the Trump administration and this next, 3+ years is not going to be, them going after big companies and trying to, take them apart and all those sorts of things. Because that was a little bit of a fear over the last few years. And I think that this situation, so if anything, I think this might give some more comfort to even like Amazon. I think this might give some more comfort to Meta. And I wouldn't actually be surprised if a lot of the big tech stocks rally on the back of this. Like this news, yeah, it's great for Google, but I think it's also good news for Meta. If there's any fear about, could Facebook be separated from Instagram and WhatsApp? I think at this point in time, you got to throw that out. Could Amazon have to divest of AWS from the e-commerce business? That'd be so silly. I think no. Okay. And I think situation like this gives more confidence. So if anything, I think big tech can rally on this. But the stock that's in big tech that I think this is the best news for, guys, I think there's a stock that this is even better news for than Google. I mean, it's great news for Google, right? But there's a stock that's arguably benefits even more from this. And it's not Meta, it's not Amazon, although those ones will benefit from this as well. You know who it is? Apple. Why Apple? No one thought about, splitting up Apple. The reason being is Apple's deal with Google, from my understanding, Google pays Apple tens of billions of dollars a year. That money should go to Apple's, pretty much straight to its bottom line. If things got switched here, that could affect Apple's profitability, we can call it in the tens of billions of dollars, which would have been a big deal. You would have had a big value derating in Apple stock, and we could have been talking about Apple stock goes well under 200 if that was a situation back into with something with a 1 in front of it. Now that you got that out of there, profit's going to keep pouring in there. So the moral of the story is, I think this is bigger than just great news for Google. I think this is great news for big tech. And what does that mean? It means great news for the stock market. Because who runs the stock market? Big tech. They're the biggest weights in the S&P 500. They're by far the biggest weights in the QQQ, right? So, I mean, positive. This is a big positive, man. And it goes way, way bigger than just, Google, okay? Alrighty, next up here, I want to do a public service announcement. I need to do a little PSA, okay? First off, to everybody, I got a flat tire on my Model X, okay? I appreciate how many people have texted me, have come and rang my doorbell, all my neighbors, landscapers, pool men, everybody's been reaching out to me about this flat tire. Holy smokers, this ain't no joke, okay? I've got to get it fixed. I got to take it to the tire store in the next few days, okay? But I appreciate everybody letting me know. I am aware I do have a flat tire in the front yard of my house, okay? Thank you very much, okay? Next thing I need to make people aware of is stay away from the casino. This just was making its rounds in Las Vegas here today, city I live in. Dana White allegedly owes Red Rock Resorts $25 million, and it could be as high as $50 million. I mean, this is a crazy number. I've lived in Vegas a long time. I know the gambling industry pretty decent. I mean, it's not very often you hear about markers that can go into the tens of millions of dollars. That's crazy. And I have heard from people before that have seen Dana White at Red Rock Resort gambling some money before. So, it doesn't surprise me. And so I need to do a PSA to remind everybody, if you play at the casino, understand you're giving them your money, okay? Even the games with the best odds, you're giving them your money, and that's fine. Just understand it's a form of entertainment, and you're going to lose the money. No different than you pay to go to a movie, you lose the money, okay? The problem is people go to the casino and they have this fairy tale that they're going to always win. If you play at a casino over the long term, you will always lose. You can get lucky on a night. You can get lucky on a trip to Vegas. And, oh my gosh, I won a few $100. I won thousands of dollars. Everybody can get lucky. Oh, I hit the slot machine for a big payout. Listen, all the games are rigged for you to lose over time. That's how the casinos make money, okay? And so don't think you're going to go in and win all this money. As Steve Wynn famously said, who has a net worth of nearly $4 billion, he said the only way to win at a casino is to own one, okay? That's how you make money at the casino. Own a casino. Don't go play at a casino, man. You end up with all this, ugh. And we hear about these stories all the time. There was one that was going viral last year that Bruno Mars was big time in debt, supposedly, to, I think it was MGM. Oh, it's a bad situation. Sheldon Adelson, Mr. Las Vegas Sands. Yeah, they calculated his net worth right before he passed on. You know what it was? Nearly $30 billion. Yeah, own the casino. Which reminds me, every time I think about the Adelsons, you know what I think of? I think about how they're one of the, Vegas, we always have water problems, right? We don't have a lot of water. Run out of water. We have to reuse all our water, right? They did this study a few years ago on the homes in Vegas that used the most water. I was not on the list, okay? I was not on the list. But the number one was this Prince of Brunei house, and it used an astonishing, ridiculous amount of water. 13 million gallons of water a year this house used. It was just ridiculous. 46 bath house. Oh my gosh. But the Adelson, I always think of Adelson's because their house was number 2 on this list. I remember seeing this list, and they had the second property that used the most water in Las Vegas, just a ridiculous amount. And I've been by this house before because I've been in this community many times doing photo jobs back when I had my real estate marketing company. But yeah, this was their, you can't even call it a house. Like, it's just ridiculous. Like, I don't even know what to say about that house. Just absolutely insane. Floyd Mayweather, by the way, Floyd Mayweather's house came in at number 37 on the list for the most water used. Dana White, or Mr. Dana White, Mr. supposedly 25 to 50 mil in debt to Red Rock, right? Dana White's house came in at number 6. Number 6. Oh, and then the ones that own station casinos, the Fertittas, which supposedly Dana White owes a bunch of money to, they were on the list several times. The Fertitta Family Trust has homes in Summerlin, landed at number 9, up from 32. Lorenzo and Victoria home comes in at number 3 and number 57. So they're all using the water. And new money versus old money. A lot of these people live in this old money community. I know this community. I would never live there. I gotta be a billionaire. I would never live in this community. This community, I don't like it. It's like everybody there just wants to live in like a little jail cell. They put all these trees around them for, I guess, privacy, and then they like the gates in front of their gates. This is already a guard-gated community with security, by the way, and it's just like, it's not how I want to live. And so it reminds me of you guys ever seen The Great Gatsby? And the old money guy is always looking down on the new money guy. I'm a new money guy, so I like. My next house is going to look over the whole city, right? I like all the openness, and just like, I don't want to feel like I'm in a little jail cell. I like all that openness. You look over the city, but that's new money mentality. This old money, they like to live different, right? Like, I look at this old money and I'm like, you couldn't pay me enough to live in a place like that. Like, what? Ugh. But there's new money versus old money. The old money looks at me and they're like, ugh, I don't want to live the way you live. I look at the old money and I'm like, I don't want to live the way you guys live, right? I mean, 10 years ago, I was living in a 1,200 square foot apartment, right? You know what I mean? Like, all my big money all came in the last 10 years, with all the stock success and the YouTube success and all that. New money versus old money is a real thing. Like, people think it's just a Great Gatsby. No, it's a real thing, man. The new money, we look at them, we're like, I wouldn't want to be you. Old money looks at us like, we wouldn't want to be you. It's life, man, okay? Alrighty, guys, next up here, the 4 stocks I bought here today and why. Well, number 1 was Nike. NKE. Bought 77 shares of Nike. About a $5,700 move in the public count. First off, I had $150,000 plus just chilling in the public count, kind of cash from some profits taken throughout this year. So I spent, $30,000 plus of that today. But yeah, 77 shares of Nike. And when it comes to Nike, am I worried? Because this is a position I'm down on 4% in the public count, down $8,600. I'm 0% worried. 0% worried, right? Nike's already bottomed, first off. Like, it already hit that $50-ish bottom, right? So, we'll shake around. Like, could the stock hit a 60 again? It's always possible. But I do not believe we're going under the lows that we already reached several months ago, essentially, which was, I think it was 52 or something like that, 55, somewhere around there, roughly, right? But short term, I'm the short term we all know at Nike is in 2025 is just not good. It gets better in 26 and it gets a lot better in 27. So I'm 0% worried about Nike. Like, every decade, they got the right CEO there now at Elliott Hill. I've already seen him make some great moves. And so I'm 0% worried. Now, some people say, why buy Nike? Why not Lulu? Because Lulu's been hammered, right? Hammered. Brutal. The thing with Lululemon and why I want to buy Nike over Lululemon is Nike's brand has proven itself decade in and decade out since the 1980s, right? And I've gone through this many times in the channel before about Nike and, major stock price declines and, the business being questioned. But at the end of the day, every decade, they're more relevant than the past decade and they make it through, right? I don't know if Lulu's going to be able to do that. The reason Nike's brand is able to get, have so much success decade in and decade out, because they spend such an unbelievably absorbent amount of money on marketing, on, making sure the best athletes in the world are wearing their products and they get those moments and they have their logo everywhere. And you think of their logo, you think of success, you think of people winning championships and holding up trophies, and it's just phenomenal. Lululemon doesn't have that. So Lululemon is known for having an extremely successful yoga pant. Nike is known for having championships. And there's a big difference there. Nike is known for Michael Jordan. Nike is known for the best athletes in the world wear their products. Lululemon is known for a successful yoga pant. The yoga pant that every woman's wanted the last 10 years, right? There's a lot of competition in yoga pants now and all those sorts of different products. And so Lulu hasn't done enough to make a brand that you say, yes, this brand is going to be a banger for the next 20, 30, 40 years. They made their brand around a product. Nike built their brand around the most successful athletes in the world in sports. When I go to buy a Nike product, I'm not thinking about the pant or the shoe. I'm thinking about, does it look good? And I'm thinking of success. And it's a big difference. And so I think Lulu is still dangerous. Nike, on the other hand, I don't look at it as dangerous at all because they have a brand that makes it through. They have a Louis Vuitton brand that you just make it through, right? Sometimes Louis Vuitton's a little more on than other times. Sometimes Nike's a little more on than other times. But at the end of the day, they get through their bad times. And the thing you got to understand about an extraordinary brand like a Nike, their bad times are still better than everybody else's best time put together. That makes an incredible business. That's why I choose Nike over Lulu. That's why I haven't been bullish on Nike or on Lulu the last several years, because I've looked at that stock and I'm like, like there's a lot of risk that people don't understand. If you just look at the numbers, if it was just about the math and the numbers, you could make a great case for Lulu. But when you dig deeper and you start understanding human psychology, brands, all those sorts of things, marketing, then you start to put pieces together and you're like, oh, dang, if Lulu was really spending aggressively to build their brand, I would think differently. But you know what would happen? If Lulu decided they were going to go out there and start buying the best athletes in the world, putting Lululemon all over everybody's jerseys and get in with the NBA, and you know what would happen to Lululemon's math? Get devastated. They would probably start losing money because they would have to spend so much money that they would probably start making very small profits. Their margins would go to crap. And then investors would be looking and like, we're spending all this money, are we going to get the payout for it? Nike gets away with the crazy spend they do because they've already proven their business model. With Phil Knight way back in the day. Lulu hasn't. So if Lulu's decided, okay, we're going to spend another $500 million on marketing, on athletes, on all this stuff next year, investors would be like, huh? You can't do that. No. Stock would crash way worse than what it's crashed right now. That's the important part to remember, and that's why Nike always has a competitive advantage over everybody. And so all these different shoe brands, athletic brands, they come and they go. Decade after decade after decade. And we'll be the 2030s, we'll be talking about the same thing. Nike's going to be dominating again, right? And then I'm sure there'll be some new brands, and we'll be like, oh man, new brands coming to take out Nike, right? Oh, they're going to come eat Nike's lunch. It'll be like 2035, we'll be having that conversation, and that brand will then falter, and Nike will remain, and it's just the same story repeats itself again and again and again. Next one up here I bought, number 2 of these 4 stocks, is Honest. HNST. It was about a $5,700 move here. Honest just way too cheap. I'm looking at the stock at $383 here today. I love Honest. The CEO's taken over the last few years. Carla has done an amazing job. Like, look at, since she's taken over that company, right? Look at what's happened to its revenues, margins, profitability, cash flow. It's unbelievable. Unbelievable. What a turnaround. Look at its income statement now versus, right after she took it over. Look at its balance sheet now versus right after she took it over. It's not even on the same playing field. Like, it's unbelievable. So I have so much confidence that Carla is going to continue to build out this company and get them through whatever they need to get through. And it's a need-based business model. Like, you look at everything they sell, diapers, wipes, beauty products, all that sort of stuff, like very needs based. I like Honest a lot here. I think the stock's been heavily disrespected, and I don't think it's going to remain like that. Okay. Next one up here, number 3 of these 4 stocks is Adobe, ADB. So about $7,500 move here, $353 a share I paid for these Adobe shares. Listen, I understand this is a hated dog stock right now. No one wants a piece of Adobe, right? No one wants Adobe. AI is gonna destroy the business model, all this stuff, right? I understand, I get it. But at the end of the day, here's the deal with Adobe, okay? This is Google 2.0. So Google, the fascinating thing about Google is it's been trading way too cheap the last year. And the reason it's been trading too cheap is because all these worries. ChatGPT is going to disrupt it. The government's going to take them apart, blah, 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 right? All these worries, right? And all came, to basically not matter. And so with Adobe, I see a very similar situation. I see the stock trading at a forward P of 18. I see the 2-year forward P of, we can call it around 14, 15. For a business model like this with these sorts of margins, like, come on, man. And so I look at Adobe and I see a Google 2.0 situation. I see a stock that as soon as it starts to move, it'll move 50%. Quick. That's why I'm buying out as many shares as aggressively as I can, right? Without trying to get overexposed to stock. In case I'm wrong, whenever I buy stock, I understand I could be wrong. Might not be the one, right? Might make a mistake. I don't think I'm wrong on here on Adobe. I think I'm going to be right, and I wouldn't be surprised if we fast forward a few years from now, and I'm sitting on massive gains for Adobe if I still hold it. Then I wouldn't be surprised if it's a year in the future and I'm up 50% plus on Adobe. I wouldn't be surprised at all. Once that stock moves, it's going to move fast, just as Google has done, right? No, Adobe was one of the stocks I featured on 4 Stocks I'm Buying Now, September 2025 edition. It looks like about 103,000 people have gotten to see that so far. If you want to hear me talk in depth about Adobe, you can go ahead and watch that video, okay? Next one up here I bought is a brand new stock. It is Whirlpool, WHR. A surpriser. Whirlpool. What the heck, Jeremy? You're buying a washer, dryer, oven, refrigerator company? Oh my gosh, right? They own KitchenAid too. They make those awesome mixers. We got one at my house. You got to have one of those mixers, man. Those are the OGs. Here we go. Start a position today in the public count. $90.81. 110 shares. This is a fascinating stock because I got a lot of pushback on Whirlpool. I really did. And a lot of people are like, I don't know about that one, Jeremy. I don't know about that one. And I get it, and I like it, and I welcome that. I welcome the questions. I don't know about that one. Whirlpool, Jeremy? I don't know about that one. Now, you can obviously watch that video. It was the first stock I featured on the video. So if you want to hear my case around Whirlpool, I think it's a pretty strong case on why that stock could do tremendous the next 2 to 3 years. Right? And you didn't hear me talk about the stock's going to do tremendous for the rest of this year. Like 2025, this year's thrown out. But I think the stock's going to do great, 26, 27, 28. And I made it, I think, a very strong case. But a lot of people are still like, I don't know about that one. And I welcome that. I love that. I love to have a dialogue. I love to, the old Jeremy would have gotten offended by that. How dare you even question one of my stocks? Nowadays, I'm like, okay. Like, I actually look for more bearish articles on a stock or bearish commentary on a stock than I look for bullish commentary. My mentality's really been changed over the years, and I welcome it. I really welcome it. I love it because I want to always see, like, is there something I'm not seeing there? Even in regards to the market, I like to hear more bearish commentary than bullish commentary. I specifically try to listen to more perma bears because I'm just like, is there something I'm missing here? Let me hear the bearish argument. Let me hear it from the people that look at the world glass half empty. Let me hear what they have to say. And if I can listen to them and deal with that and be able to say, you know what? Okay, that's not actually a big issue. Then we're talking. I don't want to just be naive and not hear it. I'd rather hear why it's bad. Why it's not going to work, why it's going to be a bad investment. It makes me think a little harder. Sometimes there's a point where I'm like, dang, that's a good point. That's a good point. How do I counter that? Or maybe it's not worth countering. Maybe they're right and I made a mistake and I got to move on. So anyways, I welcome that sort of stuff. If you want to hear my case around Whirlpool, you can certainly check out that video, okay? It's Labor on Labor Day. So last night I released a video on the main channel, 4 Stocks I'm Buying Now. I talked about a brand new stock I'm looking to add in September, essentially. And then I did a little research last night on a company I've been keeping an eye on. I did some more research and I'm like, this other company, I think I also want to add as a brand new company. So we'll speak about that at the beginning of this video, why this other company also has me intrigued. So as a potential, I buy either one or maybe even two brand new stocks in the month of September, which is actually pretty rare to see me do. So we'll speak about all that at the beginning of this video. I'm looking forward to sharing my thoughts, opinions in regards to this subject. After we get done going through that, I just want to react to about a 4-minute clip here from this video, Tom Lee, a new bull market until 2035. So I'm looking forward to sharing my opinions and perspectives there on about a 4-minute clip. And then we're going to react to this little clip here from Dan Niles just a few days ago. He was speaking about valuations, the market being addicted to easy money, and I kind of wanted to share my opinions and perspectives there. I appreciate y'all for joining me as always. I hope you appreciate me doing this video for you guys on Labor Day. I figured I would do you guys this video, and then I'm gonna probably barbecue. I'm gonna probably cook up some food, some bunch of different meats on the grill, do something like that for the rest of the day, and maybe take the rest of the day off, maybe go in the pool, something like that. But I want to get you guys out of video. I know a lot of you guys are probably wishing the market was open, so I appreciate you. Only thing I need from you guys, smash a like button. If you could just do that for me, that means the world. If you want to be subscribed to the channel, you can certainly subscribe. Additionally, we got a few hours left here on the my highest Patreon tier. If you want access to that, I'll put it as a pinned comment down there today. Looks like we got a few hours left there to take advantage of that. That's for my #1 stock market course ever, ability to see the stocks I'm buying and selling each week in the Patreon portfolio, and access to the Patreon Discord chat. Okay, so once again, that will be pinned comment down there, and I hope you guys enjoy that. I hope you get a lot of enjoyment out of that course and getting to see how I build a portfolio each and every week. And that's a $49. There's also an annual plan if you want to join that. You even save more money on an annual plan, so it's up to you. Whatever way you want to go is whatever way you want to go. Okay, alrighty guys, so let's get into this. What is this other stock that has me really intrigued as a potential buy? I'll show you exactly what it is. It is LVMH. LVMH has me very intrigued here, okay? Now, LVMH, if you are not familiar with the company, they own a ton of super high-end brands, okay? Louis Vuitton. A ton of super high-end brands. You know, this gives you a good illustration of, you know, many of the brands they own. And it's not just like, oh, they just make purses and wallets and things like that. Like, that's a whole business for them, right? And they own a bunch of different brands kind of in the fashion space, but they also own a lot of high-end liquor brands as well. So do keep that in mind, and you get a good understanding of that. This is really a conglomerate of high-end brands, essentially. They own Sephora and a bunch of other different makeup brands and makeup products, okay? Additionally, they own watches, jewelry brands like Tiffany, right? So, you know, you can look this over, you can pause the video if you want, but obviously they're conglomerate. You know, people hear the name and they think it's just Louis Vuitton. No. Like, Louis Vuitton in itself might be $100 billion plus company, right? But when you add up all these other brands, it's a very valuable company because, you know, they own so many of the high-end spaces. Now, the thing that has me really intrigued about Louis Vuitton here is it's not a crazy valuation on this one. The forward P's in the 20s right now, right? Which is not bad for a company with these sorts of brands. The company is expected to get back to very nice growth moving forward, so do keep that in mind. Now, stock has been a disaster. It's been a dumpster fire of a stock. If we look here, you know, this is since we kind of, you know, if we look at that like November peak, right, where the market was kind of peaking, November 2021 that was, right, which was before we had the bear market of 2022. If you look since that time, Louis Vuitton here, LVMH is down 31%. The Qs are up 41%. SP 500 is down 37%. So it's one of just many stocks that has underperformed to a great extent over the past 4 years. You can chalk it up with Nike and Estee Lauder, EL, and a lot of other companies that have just really underperformed in the last number of years, right? But the interesting thing is, I'm kind of looking at a lot of these companies as like good companies to bet on for the next 5-10 years. You know, and you've obviously seen me place big bets on Nike, big bets on Estee Lauder, and those are starting to pay off, but very early innings in regards to that. I think those are going to pay off very handsomely over the next 3, 5, 7, 10 years, right? So I look at something like LVMH and I see a lot of similarities here where, you know, it's a great company with great brands. They know what they're doing, right? They really cater to the high end for the most part, and they put up their numbers, right? And they've gone through a tough time in their business, like many of these companies are. But as somebody that's thinking about companies several years out, I don't care what Louis Vuitton's numbers. If I buy the stock, if I actually start buying the stock, I don't care what Louis Vuitton posts for numbers, next quarter or the quarter after. It means nothing to me. But I do care about what numbers Louis Vuitton would post in 2026, what numbers Louis Vuitton would post in 2027, 2028, 2029. That's going to matter to me substantially. So now let me show you projections I ran here on Louis Vuitton and why this is actually pretty interesting as a stock, LVMH, okay? So here we are. We're looking at 1000xstocks.com. I ran you guys a bull case for me, a base case, and a bear case. And you can see why this is pretty intriguing. Let me start with my bear case for Louis Vuitton. Here we go. Bear case, I had them doing only 4% revenue growth per year, 2026 to 2029. That would be bad. Bad. Okay, I have them only doing 5% net income growth per year from 2026 to 2029. Very bad. That would, like if LVMH only does that over this next 4 years, it'd be bad. Now, considering how great the brands are this company owns, if they could grow, mid-single digit revenue growth, mid-single digit net income growth, you're probably going to command somewhere around a 25 to 30 PE for this company, which puts the stock somewhere between about $650 and about $770, right? Which gives you a compound annual growth rate of only 2% on the low end and 7% on the high end. So not very good. Yeah, if the bear case came true for LVMH here, it would be kind of a waste of money. Like I could still make money on the stock over the next few years, but not much money. It'd be very tough to get gains. Base case, my base case for LVMH here, remember, my base case is what I expect to happen. Now, usually my base case is a little conservative, but this is what I actually expect to happen, okay? Keep in mind, net income growth should be coming back very strong in 26, 27. In future years here, they kind of gone through a down cycle in their business, and as they get back to nice revenue growth, their net income should fly up 26 and past, okay? So I have them doing 10% revenue growth on average, not a crazy number for the company to do, 2026 to 2029. And them doing an average of 15% net income growth, 2026 to 2029. Once again, not a crazy number. That puts them at net income margins of 15% come 2029. Not a crazy number, considering, their products have phenomenal margins, right? They do spend extensively on advertising, marketing, things like that. So do keep that in mind. But 15% net income margins for them in 2029, that's not a crazy number. Though, given the company, the brands, that sort of growth rate, you're probably at a 28 to 33 PE ratio for the company, which puts the stock a little over $1,000 on the low end to potentially $1,200 plus on the high end, which would give me a compound annual growth rate on the low end of 15% and a compound annual growth rate on the high end of 20%. Now, keep in mind, this is something very important I mentioned here. I'm running my intermediate projections here for LVMH. I could run my advanced projections, which we have the advanced feature on 1000X as well. These are just intermediate. Now, the important thing to understand is under advanced, you can also factor in if they buy back shares. Now, with a company like LVMH, my guess is they're going to probably buy back a lot of shares over the next 4 years, as that cash flows build back up in 26 through 29, which then would allow them to essentially have their earnings per share be up to a greater extent, which means a compounded annual growth rate I could get on the stock might actually be much higher than 15 to 20%. That's just something important, and that's why we had advanced projections on 1000xstocks.com as well, and not just the intermediate, okay? Because the intermediate, you can't factor in, what if this company buys back, 5% of their shares every year for the next number of years, okay? Alrighty, let me show you my bull case for LVMH now. Here it is. So under my bull case for LVMH, I have them doing 15% revenue growth per year, 2026 to 2029. And then do net income growth of 25% per year on average. Now keep in mind, LVMH, they sell all over the world. This is not a United States and European brand. They have huge business in China. Huge business in Asia in general. So it's at the end of the day, their brands are respected, loved, and bought heavily across the world. So just something to keep in mind there. Net income growth, 25% on, when it comes to net income growth per year. So if you're doing 15% top line, 25% bottom line for LVMH, you're probably commanding a 35 to 45 PE ratio, which would put the stock somewhere between $1,800 and $2,300 in 2029, which would give me a compound annual growth rate of 32% low end, 41% high end. That would be beautiful. Now, that's a bull case, so Just like bear case is like a lower probability, bull case is also a lower probability. This is more realistic in my opinion, which once again, you push close to that 20% CAGR. It's hard for me not to buy. If I run a base case on a stock and I get a CAGR around 20%ish, it's very difficult for me to say, you know what? No, I'm not going to buy that stock. I mean, especially when it's a company I know very well, I like it. I can understand the business model. Tough. Alrighty, let's go ahead. Let's react to some videos here.
Basically, if we really step back, been bullish since 2011. And as I've said repeatedly on the dips, told people to buy even at periods of great market stress. And, we've been chatting on CNBC through the years where I've thought, gosh, how's he doing it again? And you've ultimately proven to be right on all of that. What, stepping back, do you think you have seen over the course of the last 10 to 12 years? Or what have you put more weight to than your rivals that has allowed you to get so much of that correct?
I think it's a couple things, Wilfred. I'd say I think when it starts with our evidence-based work, we put a lot of weight into understanding demographics and then the role history plays, like in each context. But I think it is one of the really misappreciated things that demographics really explains almost every bull market since 1890, actually. So if you followed every generation, the gaps between the generations are really where the bear markets exist, and the bull market tops coincide with the peak of a generation. So 99 was the peak of the boomers. 74 was the peak of, I think it was called the generation before the silent generation. Gen X peaked in 2018, and millennials will peak in 2035. So those are like rough waypoints for when actual major tops take place. I think the second thing that we found is investor.
Okay, what's my 2 cents on that? Do I think what Tom Lee's talking about here is important in regards to market tops and generations and things like that? My thought is no, a bunch of baloney. Like I don't believe in that at all. Just to be quite frank, in generation tops and things like that, you just have interesting phenomenons. Like I feel like you can always try to find some statistics to try to point at this or point at that. Like 2018, in that drop at the end of the year, it had nothing to do with a generational top. It was the Fed was looking, Trump wanted to lower interest rates. The Fed didn't want to lower, right? Valuations got a little stretched on stocks, and the market was worried about a lot of different things, tariffs and blah, blah, blah. And we had a drop, no different than we had a drop this year, right? When the drop we had in the drop we had this year in 25, that whole market topped around February 19th, and then it bottomed, I think it was April 9th. It was a very severe correction very quickly. That was very similar to what happened in 2018. Just the difference is 2018 was at the end. Are we going to say that was a generational top? No. 99 in the whole, tech bubble pop had nothing to do with a generational top. That was stocks were trading at just ridiculous valuations, and companies that had no real business models were trading at multi-billion-dollar valuations, all this crazy stuff. That had nothing to do with a generational top. It was just silliness going on in the market. And there was a come down from that. And it was a very painful come down, right? And so, many of those stocks never got back to their old price. I think Cisco still is less today than it was back at its 99 or 2000 peak. So, we can, I just don't believe in that at all. What Tom Lee just spoke about there, it was other factors on why those markets came down.
As they age, become wealthier, but for when actual major tops take place. I think the second thing that we found is investors, as they age, become wealthier, but then they become more skeptical. And so most of the wealth in America is held by older people. Okay,
before he goes further, 100% I believe in that. 100%. I'm sold on that point. It's very common for older folks, I don't know what it is, but they get in this mode of doomsday, end of the world, right? I think I even heard Dave Ramsey say at one time, old white guys have a fascination with the end of the world. And I'm like, dang, it's kind of true. Dang, that's a good point. I don't know what it is. I don't know why that is. But it's actually a lot of truth to that, just to be quite frank. There's a lot of truth to that, man. Like, believe in that.
But then they become more skeptical.
They do become very much more skeptical.
Most of the wealth in America is held by older people, including institutional managers, right? They're over age 40. But the world in disruption is caused by young people. So I think investors tend to think their own wisdom drives the economy, and it's actually, they need to put on the lens of a 20-year-old. That's what we do at Fundstrat. We survey constantly, so we think about what young people are doing, and they drive ultimately the markets and economy. And the third thing is
true. And Gen Z gets a lot of hate, now because they spend they're spending so much, they're going to Coachella and all this stuff, right? Listen, all these people spend all this money. A lot of the younger generation is what spends a lot of the money. That's just always been the way it is. A lot of the spending does not come from a 65-year-old. It just doesn't. 65-year-olds usually aren't going out there to buy a new house and looking to, buy a bigger house. They're not usually looking to go buy the fanciest new cars and go out to eat every other night and go to the bar and get drinks. Like some are, sure, there's some 65-year-olds that are living that life, but it's not very many. On the other hand, 25, 35-year-olds, 45-year-olds, they are looking to do all those things. And so that's what keeps the world spinning. You know what I mean? Like, that's the thing you got to understand. And so, you can hate on, oh man, people spend so much money, they do all this, do all that, At the end of the day, somebody's got to go buy all those iPhones, right? Somebody's got to do it. So somebody's got to go buy all those Coachella tickets, right? Yeah.
I think we don't lack recency bias. Like, we turned bullish at JP Morgan on February 2009, and we identified upcoming low that would look like 29 or 74.
Which was the following month, right?
Yeah, it happened. Yeah, so we were a month early. So we suffered a drawdown.
We'll allow you that 1 month error.
Yeah. But what was interesting is that people were skeptical because that generation of investors just went through the dot-com bust and now the GFC, so they were now equity skeptical. So they couldn't imagine anyone would want to own equities for the next decade. But that bias is the reason why stocks can positively surprise. And so and even most recently, I think there's a bias now of people having a pessimism about inflation.
By the way, before he goes further here, what he just said there is very important. That's going to happen again. When does it happen? I don't know. In 3 years, 5 years, 7 years, 10 years from now, I don't know. But that will happen again. A scenario where the market will get hit hard, and it won't come back that strongly. It will come back some, but it won't come back that strongly, and then it'll end up getting hit again. And so that happened, obviously, in the tech bubble and then the great financial crisis. Tech bubble stocks got destroyed for a couple of years there, and they started to come back to life over the next few years. And then, just when they were back, they got slammed again in the great financial crisis. We'll have a situation like that happen again. I just don't know when it is. But it will happen again. And people will get very skeptical, and that's why you got valuations just at dirt prices back in 2010, 2011 on stocks, because a lot of people didn't believe in anything. They didn't believe in the market. They're like, it's just going to go lower. There was no belief in it. Now we have a lot of belief in the market. The market's been very strong since the great financial crisis. Obviously, we've had crashes since then. We've had small corrections since then, and we've had severe corrections since then. But at the end of the day, it's up, 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 right? So there's not a ton of long-term skeptical viewpoint on the market right now. There might be a short-term skepticism out there in the market where people are like, I don't believe in the market over the next year or 2 years because valuation, blah, blah, blah. Like, there's some of that, but long-term people skeptical? No. Like, for the next 10 years? No. Like, if you ask somebody, is the market going up in the next 10 years? Yeah. But I could tell you back at that great financial crisis time, no. I mean, I couldn't find somebody. When I got in the market back in 08, 09, you got to understand, and I told people, and I was proud to tell people, oh, I'm getting, involved in the stock market. Like, what are you passionate about? Oh, I'm getting in this market thing, right? I couldn't find somebody that said, go get them. That's awesome. Good for you. You're doing a great thing. All people said was like, oh, be careful. It's scary. Oh, it's a roller coaster ride. Oh, you're doing that? I don't know about that. Like, there wasn't one person that I remember said, go get them. Not one. Not even my accounting instructor, who I took 3 levels of accounting with in college. Not even him. He was a gold bug. He was all about gold, right? And he also sparked my curiosity with stocks in the market, but I don't even remember him being like, oh yeah, go get them. Like, that's awesome. Like, if anything, I think we might have had some debates and arguments on if gold was a better investment or stocks were a better investment back then, right? And I was so early into the market, I was not in a position to really get in debates like that back then, I could tell you that much. But like, you got to understand why people had that mentality. And Tom Lee just explained it. People had that mentality because they got smacked in the tech bubble and they saw what happened. And then market comes back all to get absolutely whammed again, right? In the great financial crisis. So I get it. I get why people were like that. And that will happen again someday. I don't know when it is. Maybe it's 5, 10, 3, 20 years from now. I don't know.
Pandemics, because we did suffer through 5 years of that, but that's causing people to now be skeptical of the world because that's in their bias. And so I think we're judgment free that way. People call us permeables, but it's really more we're judgment free.
So in terms of where we are right now, I mean, you said 2035 there on the demographics. Are we very early in a new bull market? But we've obviously had
when you have a severe crash like that, it leaves trauma. It leaves trauma in investors. And living in Vegas, I moved out to Vegas 10 years ago, right? 2015. And, got to know so many people in the real estate market because back when I had my real estate company and just, got to know friends and acquaintances and all types of people out here over the years. I mean, it's amazing to see how many people had scars from the housing bust. Vegas went through, and how many people, I've heard over the last 10 years say, I'm not going to buy a house. I'm going to wait till the market crashes again. Oh, I think the market's going to crash. Oh, I think the market's going to come down. They refuse to buy real estate, refuse to buy real estate, right? And they're still renting. They're still refusing to buy real estate all these years later and waiting for the big crash to happen. And the thing is, prices have gone up so much, even if you get a crash, it's still going to be way above where you could have bought real estate in the past. You have a big crash, like prices could go down 25, 30%, which is probably not happening. But even if it did, listen, people still would end up buying real estate at higher prices than if they just bought in the past, especially with low mortgage rates that we had prior to 2020. Like, oh my gosh. But it leaves scars. Don't get scarred by the financial markets. Don't get scarred by real estate, by stocks. Understand corrections and crashes happen sometimes. It's the cost of doing business. The bottom line is a house going to be much more expensive 50 years from now or much less expensive? My guess is massively expensive, right? I mean, I wouldn't be shocked if someday you can't get a house in Vegas for less than $1 million. I know that sounds crazy right now, but now, you go to the suburbs and just for a very basic starter house in the suburbs now, you're looking at $500,000. So, if we talk fast, imagine how much the dollar is going to be devalued over the next 20, 30, 40 years, right? Imagine how much more expensive it's going to get to construct a house 20, 30, 40 years from now than it is today. So if you think like an average house can't be $1 million plus by that time for like a starter house, I have news for you. It can easily be $1 million plus for a starter house. I'm not talking a mansion. We'll talk about mansions being 10 million plus by that time. Keep that in mind, folks.
Extended bull market already.
Yeah, I think that's what confuses folks because I would say generally we've been up since 2020, but we've had two 20% declines since. So in fact, this has been a really disrupted recovery since the 2020 lows. And so I think we are in a new bull market because we just had another essentially wipeout that happened February to April this year. I do think that the bigger story arc is that there is a big surge in U.S. prime age workforce. That's the millennials and Gen Z. Plus, they're inheriting a lot of wealth over the next 20 years, which is going to be transformed into more equity exposure, less credit. And the third is that the U.S. is at the center of a lot of the major structural changes taking place, AI and now blockchain. But those are going to really boost financial sector, which could re-rate to like 40% of the S&P. And then, of course, healthcare could benefit. So I think there's a lot to be excited about. And 2035 sounds about right. That would be a 10-year bull run from here.
That's really interesting on those sector picks, which I want to get into in a second. But sticking on the broad market for a moment.
Okay, then they get in the Fed and whatnot. That was the main part I wanted to react to there, because I thought that was a really interesting thought shared by Tom Lee there. Okay, let's get into Dan Niles.
Investment management founder and portfolio manager, and get his reaction. Dan, good to see you again.
Thanks, Carl, for having me on.
All right, so what was your takeaway from the print?
Well, first I'm going to lie to you. And I'm going to tell you, hey, I came on CNBC on Monday, which I did, and said it was going to be a really strong quarter. And, I was bullish into the print. And look, they beat the revenues and the forward numbers go up a little bit. So that would be the lie. The truth is, if you are honest with yourself, you look at this and you say, they actually missed data center revenues for the first time since any of us heard about ChatGPT at the end of 2022. I looked at the stock in the app, I looked at the data center numbers yesterday when they came out, and I'm like, oh my God, I'm going to have a horrible day today. Because, who can look at this and be bullish? And you can look at CrowdStrike, which you didn't ask about the same way, and say, hey, if you are honest with yourself, you go, the forward numbers actually go down. And the stock was down 7% in the aftermarket. You know what the best thing about both the quarters were? The Fed's going to cut rates in a couple of weeks. That's right. The best. And so I think if you think about what I said, there was an interview I had at the end of June where I said, forget about valuations, which you never heard me say, right? In 30 years of doing CNBC. And the whole reason is this market is addicted to easy money. And in that environment, you're paid to just take risks, because you're not really going to get punished. You're not getting punished on Nvidia today. You're making money on CrowdStrike today. And I think you want to look at the glass half full, and the Fed will come up with whatever reasons they need to cut. Even tomorrow's PCE, if it comes in hotter, I'm sure you'll find something in the headline, core, super core, service.
So let me push back against Dan Niles here for a moment. Okay, let me really stick up for Nvidia. Okay, because I think I need to do that. Listen, Mr. Niles, Nvidia trades at, we can call it about 2x market multiple on a forward P, right? They trade at, we can call it 44, maybe 40, somewhere in there, okay? Which is about double the market. Market in general, forward P is probably about 20-ish, somewhere around there roughly, maybe 18, 19, 21, somewhere. So roughly a double market multiple. All right, here's the thing. Nvidia, here's where many stocks EPS growth is. Here's Nvidia's. Here's where many stocks revenue growth is, right? Here's Nvidia's. Nvidia's grown way over 2x revenue growth of an average stock, growing way over 2x earnings per share growth of an average stock. So Nvidia not getting punished that bad, it doesn't surprise me at all, because Nvidia's not trading some crazy valuation. Even in this past quarter, they grew revenue, what was it, 50%? We can say 50% revenue growth. It's like 10x an average stock in the market, right? Somewhere around there, roughly. They don't trade at a 10x forward P. If they trade at a 400 forward P, then I say, oh, okay, we got a problem here, right? But it trades at about a 2x forward P. So that's why I think my belief is that's why Nvidia didn't get hammered by missing that number, because data center number is okay, it's not at a crazy valuation, it's at a very fair valuation right now. So I'll stick up for Nvidia right there.
Or you'll somehow dissect it to figure out that the Fed's still going to be cutting rates. And
as much as people want to say it's Wall Street, the game of Wall Street is very important. Do you beat your numbers, do you miss your numbers, blah blah. But also, what else is very important in the stock market? Mathematics. Math is very important in the stock market. And when you could look at a stock and you can say, it trades at roughly this, it should go to this, compounding annual growth rate should be this, math matters. So as much as the game of Wall Street matters, math matters just as much, if not more.
I think that's the overlying sentiment right now. Sorry.
You did on Nvidia last night. You did write, I'm hoping this is just an anomaly in otherwise mainly flawless execution since late 22. Does that hold this morning?
Yeah, it holds, but I've been a semiconductor person for a very long time.
Yep.
And I have sort of this rule, which is you buy semi companies when they have a massive write down and you're not in a recession, right? Because then you clear the decks and these companies can beat numbers for the next couple of quarters. So I thought there was zero chance that after having a massive write down in April, which is when I got bullish on the stock shortly thereafter, right? Because I'd been sort of thinking you're going to have a problem since the middle of 2024. And the stock, to be fair, went down 49% from peak to trough, so I would put that as a problem. And the stock's done well, but they still missed the data center numbers. So you have to then think back to some of what we've heard over the last couple of weeks. Sam Altman said we're in an AI bubble. ChatGPT 5 really was a disappointment. MIT comes out with that study saying 95% of corporations investing in AI are seeing 0% returns. And Meta, after going through a hiring, splurge, is now on a hiring freeze. So there's things that if you're trying to be pragmatic versus just saying, like I am right now, forget about valuations, you got to think about that when you get into a more normal environment sometime, late this year, maybe early next year after you're through with these.
But Dan, given that we're in early innings in the way we're using AI, is it really a surprise, say, for instance, that only 95% of organizations say that they are getting any return on their AI investment?
So 95% are saying they're not getting any return. And, you're saying that
but why is that a surprise? This is not, we're at the very beginning of the way, at least all the companies that I'm covering, when they're out and they're talking about the ways that they're thinking about employing AI and how they're going to invest in it and who they're hiring. If they were to report, no, we're not making any return on that investment yet, I would be like, okay, when is it a problem? Not, is it a problem right now?
Well, you have to remember, Contessa, you've had a massive ramp up in spending. And at a certain point, and you can look at last year as an example of this, Nvidia stock was flat to sideways or down from middle of last year through the end of last year. Why was that? Well, because you had Microsoft, Amazon, Google, when they all reported the June quarters of last year, they had the revenue estimates cut for the September quarter. Then they all reported the December quarter of last year, and they all had the revenue estimates cut for the March quarter. These stocks were struggling because people were questioning the ROI at that point. And so what I'm telling you is that not all companies are going to benefit from, you've heard a lot about on the software side in particular, there's sort of this thesis that AI is going to go ahead and eat software. Right? There was that thesis much earlier, right, a decade ago, of software eats the world, and now it's AI is going to eat software. And so there's going to be some winners and losers coming out of this. And yes, you're in the early innings of AI, but let's not forget the four biggest hyperscalers have had their CapEx double to $600 billion over the last 2 years. So it's not like at a certain point you're balancing this. And what I'm saying is for right now, you can kind of ignore this, because the market wants to go higher and valuations just don't matter when you've got easy money continuing to come. So I kind of look at this like late 1999 where the Nasdaq's up 86% in the first.
Yeah, as I've said with Nvidia many times, Nvidia, the bottom line here is with Nvidia, when they start to go to single digit growth, or you start getting hints of growth going potentially negative, that's when Nvidia's going to be in a lot of trouble in regards to a stock price. But that still might, you might have to push to 27 or 28 for that. It's not happening in 26. 26 is still going to be a very good year for growth rates for Nvidia. They're going to have deceleration, but it's still going to be a very good year. But 27, 28, what do we get there? Are we talking single digit, or are we talking some quarters could be down year over year? That's the big question, right? We're about to get into some growth stocks, value stocks, dividend stocks, some extraordinary opportunities out there I see in the market. We're getting to fall vibes because this morning I woke up, I drove the Plaid down to Starbucks and I got one of those little pumpkin drinks, because I was feeling like I need some fall vibes, okay? It's been an extraordinary past 3 years. Congratulations to anybody that's been in this market the past 3 years. You've probably had a lot of fun. You've probably made a tremendous amount of money, right? What a climb it has been. From those lows we hit back in in 2022, public count dipped just under $1 million to today pushing close to $4 million in the public count. Like, what a change, right? And we've had some drama along the way. We had the drama in 2023, the SVB bank whole situation, the regional banks, right? We had a severe correction early this year, right? Where the S&P 500 fell around 18% or so, peak to trough. NASDAQ was down about 22%, peak to trough. We had that whole drama, and, you know, that's what you have in the market. You have corrections, crashes, pullbacks, all those sorts of things over the years. It's, you know, but you need to build a great portfolio. And I live in Vegas, and right outside Vegas, we have something called the Hoover Dam. Might be world famous, okay? And the Hoover Dam, they built that baby back in the 1930s. You don't see them having to like reconstruct it every year or something like that, right? Oh, we got major problems with the Hoover Dam. No. They built that thing to last. A matter of fact, it's really fascinating, right? Basically, they did this kind of like show in the past, right? And what if everybody in the world like just disappeared, and they found that the Hoover Dam would likely end up being the structure that would survive the longest, which is rather fascinating. So let's build a portfolio as strong as the Hoover Dam. One thing only I need from you guys, and it's for you to just hit that thumbs up button, smash that thumbs up button, as the sign in my garage says. That's all I need from you guys. If you want to subscribe to the channel, if you enjoy my videos and you want to see more of my videos in the future, you can always subscribe here. The channel is free to do so. I appreciate y'all that hit that thumbs up button. You guys are the best. Okay, you make my day every single time. Now, for the people that see this video in the first 24 hours it is out, it's a good time for you, because the pinned comment down there today is going to be for the Labor Day sale. It is now ongoing, so everybody that gets to see this will be able to get my highest end Patreon tier that's usually $125 for $49. And that's not a teaser price, isn't it? It's $49 the first month, then it jumps to $125. No, it's $49 a month, and that's it. Okay, there's no like, oh, it jumps to $125 after that. Nope, it stays $49. So that will be pinned comment down there. That's access to my #1 stock market course ever, Become a Master Stock Market, which is a $997 course. Also, you get access to see the stocks I'm buying and selling with screenshots each week for the Patreon portfolio. Also, you get access to the Discord chat. That is for the Patreon as well. That is not my private stock group, so don't confuse that with my private stock group, but this is a phenomenal step in the right direction. And the Become a Master Stock Market course, if you have not seen that course before, everybody should see that course over time. Step 1, in my opinion, you learn from me on YouTube. Step 2, you join my Patreon. You learn on a much deeper level. You get access to that Become Master Stock Market course, right? And then step 3 is you join my private stock group. You get access to 1000xstocks.com, all that stuff. That's more like mastery level. Like, you're super serious about the market. Like, this is something you really, really want to do on a deep level. That's when you take things up to that level. Okay. Alrighty, guys. So enjoy that pinned comment down there to get it before the sale ends. Okay. Alrighty, folks. Stock number 1 of these 4 stocks is a brand new stock. Whirlpool Corporation, WHR. Boy, has this stock been trash. The stock is down 43% the past 5 years. Just such a trash stock. I want to start a position in it in September, and I want to build out that position over the next, I would say, 3 to 6 months considerably. I view this stock as a buy anywhere in the $70 to $110 area. And I want to buy the stock all the way into the first quarter of 2026. Now, this is a multi-year play in regards to Whirlpool. This is not some short-term trade like, oh, I want to play it for the next 6 months or 12 months. No. This is a multi-year, I think, pretty exciting cycle coming for Whirlpool that's going to be pretty much the opposite of what this company's gone through the past 5 years. We're going to have the inverse of this over the next 3 to 5 years, in my opinion, essentially. Okay, so Whirlpool, boring business. Oh my gosh. Okay. Refrigerators, ovens, dishwashers, washers, dryers, all this sort of stuff. Like, what's the big deal? They own a bunch of different brands, by the way. It's not just a Whirlpool brand, but what's the big deal here? This is a boring business. I understand, but the gains will not be boring. The money made here over the next few years from 2026 to 2028, that will be anything but boring, in my personal opinion. There's going to be a lot of money to be made in the stock. I don't care, what a business does. Like, if there's a lot of money to be made, you could have the most boring business in the creation of mankind, and that's fine with me. That's fine with me. I mean, heck, Palantir, one of my best gaining stocks ever. What a boring business at the end of the day. It's exciting what they can do to help businesses, but at the end of the day, it's like more like a software type, SaaS type business, right? Heck, even Tesla, one of my best gainers ever, made 2,000% or so in Tesla, along with Palantir was another 2,000% plus gainer. At the end of the day, Tesla, how do they make all their money? They build automobiles. Like, how boring, right? So at the end of the day, we could look at all businesses and be like, oh, that's so boring. At the end of the day, all that matters is there money to be made or not? Okay. No, Whirlpool right now trades at a market capitalization just over $5 billion. That's for the whole company, all the brands, everything. Okay. A little over $5 billion. Now, Whirlpool's net income in the past, this is where things get really compelling here, in my opinion. Whirlpool's earnings over the past few years have been dumpster fire. Okay, 2022 through 2025, dumpster fire for their net income, right? I do not believe that's lasting. I believe they're going to get back to their old net incomes. Now, what are their old net incomes? Their old net incomes, this company used to bring in $1 billion plus a year in net income, folks. Now, remember where that market cap's at right now. Everybody's pricing this company like they're never going to be able to get back there, and I 100% believe they are going to get back there over the next 3 years. The worst case scenario I see for Whirlpool over this next few years is them getting to somewhere where the company used to be in kind of like 2013 to 2016, where they were bringing in anywhere from about $600 million in net income a year to around $900 million of net income a year, okay? Now, this is why this is so significant, okay? Because when you look at this company, okay, like, what's going on here? You got to understand, existing home sales have been brutal the past 3 years. How brutal? We're talking, ladies and gentlemen, that home price sales have dropped and collapsed. Not dropped, they've collapsed to great financial crisis type numbers. You remember when we had the 1 in 100 year housing bust in the United States of America? That's how bad things have gotten in the United States when it comes to home sales. The only difference between this and the great financial crisis is the prices didn't collapse. The prices collapsed in the great financial crisis. Many markets went down 20, 30, some 40, some 50+% in regards to pricing. We haven't had that, but in terms of the amount of homes being sold, that's completely collapsed off a cliff. This is where we're at in the great financial crisis. This is where we're at right now. We're going through a great financial crisis in the housing market for the last several years, just without the price collapse. But in terms of people moving, now this is so significant because what happens when somebody moves? The chances they go buy a new refrigerator, washer, dryer, oven, microwave, blah, 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 all goes up exponentially. A lot of times if people are just staying in their same home, they don't end up going to buy that stuff unless it breaks. And they are forced to, I got to go get a new washer. My washer broke, right? My dryer broke. My refrigerator is not working right. Whatever, right? But that's when a lot of that happens. But the thing you got to understand about this is even more extreme. This great financial crisis 2.0 we've been going through in the housing market where home sales have just collapsed off a cliff. This is worse when it comes to existing home sales than what we face back here. Because you look at the numbers, you're like, okay, it's about the same. No, it's much worse. You know why? More people live in the United States now than back then. A lot more. How many more? Over 40 million more people live in the United States of America now than back in 2008 when we were going through the great financial crisis. Over 40 million more people. So when you look at this number, understand there was a lot less people living in the United States back here. So this is way more dramatic. This is way worse when it comes to just a complete collapse in existing home sales, right? And to kind of give you a little I want an AI to basically put me a picture together to illustrate 40 million people. But unfortunately, AI is, I guess, not advanced enough to do that. Or maybe the numbers is broski. It's too much. Okay, you can't do that. 40 million? No, I can't fit that in a picture, right? But to give you some reference of how insane of a number that is, right? The entire state of California has less than 40 million people, right? All those massive cities, in California, still less than 40 million people. The population of Canada is around 40 million people. So we basically have added, Canada in the United States just since the great financial crisis. That's insane, right? So the next question should be your brain should start putting things together and piecing things together, right? Your little AI brain here. Why am I confident that home sales will pick up over the next several years and get back to more normal territory, right? 2026 to 2028. Why will these home sale numbers not remain dead? Let's fast forward 3 years, 4 years in the future, and we're still just at these, insanely low ranges for existing home sales. Why am I confident it's going to come back to life and not remain dead? There's 3 parts to this. And all 3 of these I see playing out. All 3 don't need to play out, and I think there's still going to be a massive pickup. But if all 3 play out, we're going to have a massive increase in terms of amount of people moving over the next several years. Okay, part one, the price shock everybody went through with, home prices in 2022 and 2023, right? Everybody's like, oh my gosh, homes are so expensive now. That goes bye-bye in 2026 to 2028. Whenever something happens where a price goes up a lot or something extreme happens, right? There's a price shock that comes along with that. And it lasts a little bit. And I took a picture of an iPhone here because when the iPhone came out, it was around $500 and everybody was in shock. $500 for an iPhone? That's insane. Now no one even bats an eye and the iPhone sells for $1,000. The price shock went bye-bye, right? And that's just what happens when something's at a certain price for a certain amount of time. I mean, you could have even looked at home prices 10 years ago in 2015. And if you had been, used to home prices 10 years before that or something like that, or 20 years before that, you would have thought that was high. At the end of the day, the price shock goes bye-bye as years tick on, which helps people wrap their head around buying a new house, right? Part two, we've seen weakness in regards to home prices, right? A lot of markets are seeing falling prices. A ton of markets in Florida, Texas, Arizona, Louisiana, Colorado, even some areas in California are seeing prices go down. Now, as prices weaken in a lot of these different markets, right? People start saying, okay, I like what I'm seeing here. It gets more realistic to be able to afford a home. If the prices come down, guess what? You're more incentivized to be like, you know what? Let's go ahead and move. Let's go ahead and buy a new house, right? So this is a huge component of this. And I don't see this trend switching in the short term. If anything, I see continued weakness in a lot of these markets in the short term, right? Before they kind of bottom out and then, maybe slightly head up or stay flat for a while from there. No, I don't understand. A lot of people will ask, like, what's happening with Vegas? Right? I live in Vegas. Why is Vegas not on the list? We know Vegas got hit the hardest of any. I don't think there's any home market in the United States of America that got hit worse than Vegas. Prices fell well over 50%. Why is Vegas not on this list of all these, basically states, cities that, we see home prices falling? You think you got to understand about Vegas, right? We have a few things working for us. The mountains surround the city. There's been such an increase in population, such a build out that we're at the end of the mountain ranges. My house, literally, what's right behind my house? It's not more houses. It's a big, big mountain hill, whatever we want to call it. You can't even build on it, okay? And so this is what's going on. And then you have all these Californians always moving here to Vegas, right? And you have no state income tax, which can attract even folks that are more toward retirement age, retirees. A lot of retirees love to move to Vegas all the time, right? People from across the country love to move to Vegas because they look at it as, hey, there's no state income tax there. If I can make the same amount of money, I'm going to have a lot more money in my pocket versus paying another 5% to some state you live in, right? So you always kind of have that. And that's why Vegas is, doesn't really see that weakness here. If you look at the population in Clark County, 2010, 1.9 million. Now we're up to about 2.4 million people roughly live in Vegas, right? And by 2040, 2.9 million are supposed to live here, which, their estimation might end up being low there, okay? Now, part three of this whole story, mortgage rates. We know two big factors come in when you think about the financial side of somebody moving. Two big factors. What's the price of a home? What's the mortgage rates? We've already topped in regards to mortgage rates now at this point in time. And we are in a multi-year downtrend for basically mortgage rates, right? We were on a several year uptrend for mortgage rates where that 2023 top. Now we're on a several year downtrend. Now, if inflation remains, let's call it sleepy over the next few years, the Fed continues a lowering cycle, we're going to get these mortgage rates likely. I do not expect us to get down to these ranges we were in 2020, but I do expect us to get more into that 5% range, which would be a very healthy number where you get a ton of people moving. And I think we probably get there. My guess is in the next year, maybe year and a half. And so if that plays out there, that's pretty meaningful for a company like Whirlpool, for the housing market, get people off their butts and moving, right? Now, additionally here, the company has over $1 billion in cash and cash equivalents, right? So they can ride out the end of this little mess, and there's a mess short term, right? You have a lot of competitors have flooded the market before the tariffs with a lot of inventory. But I'm not investing in Whirlpool for their 2025 numbers. I don't care what they report next quarter. I don't care what they report the next quarter, because those are the next two 2025 quarters. I have 0%. Like, I'll look at the numbers, I'll still grade the income statement, balance sheet. I do not care at all what Whirlpool reports for numbers the next two quarters. They could miss by 1,000 miles, and it means nothing to me. Nothing. All that matters for me is what 2026 numbers look like, 2027 and 2028. That's why I'm investing in this stock. But they have plenty of cash to ride out the rest of this little short-term situation that's going on here for Whirlpool, okay? So my belief here in regards to Whirlpool is Whirlpool gets back to $1 billion plus of net income, 2026, 2028, right? If they do that, I think the company's going to a $10 billion plus valuation, which would put them at about a 10 PE or so. So let's call it, maybe they get a little over $1 billion of net income. Maybe they're at an 8 PE, somewhere around there roughly, right? 8 to 12, let's call it. Now, 8 to 12 PE is insanely low for the stock market. Insanely low, like ridiculously low. But understand a company like Whirlpool is never going to trade at some ridiculous high PE when they're in a major profit cycle. And the reason being is people understand the business is cyclical. So they might be able to do $1 billion or so of net income for 3 or 5 years straight. And then we have the next bust, and, Whirlpool all of a sudden is in a situation like they're in right now where they stop making nearly as much money, right? So you're never going to get a crazy PE on this. This is no Palantir where you're going to command a 450 PE ratio or something like that, okay? It's just not that sort of stock. And it doesn't need to be for me to double up my money, right? And so I view Palantir as I get a double up over the next few years. And then I'm in a situation where I can cash at that time, or I can hold it long term. Whatever way I want to play it is whatever way I want to play it. But I kind of look at Whirlpool as a double up opportunity here. Okay. Alrighty, guys. Next one up here. Stock number 2 of these 4 stocks is Google McDougal. So Google McDougal, this is one I started buying here recently in different portfolios, including in the public account. Public account, April 23rd, 2025, about 444 shares. I moved fast on those, and I'm glad I did, because I'm already up $25,000 on those Google shares I added there on April 23rd. You see an opportunity, you got to pounce. Now, I think it's very important I remind everybody what type of company Google is. This is a tech conglomerate. They own Google Search, which is used just as much as ever before, right? I use Google Search many times a day, every day. They own YouTube. You're watching this likely on YouTube right now. Although I do release my videos on X as well. You could be watching on X, but more than likely you're watching on YouTube. Android. They own Waymo. They own a huge consumer cloud business and a huge corporate cloud business as well, which has been expanding very nicely over the last few years. Additionally, Gemini, right, in their AI products, they also have a big hardware business, and they own a bunch of other businesses as well. Okay, that's just like the bulk of some of the most important ones there. Now, when it comes to Google McDougal, I posted this inside my private stock group here. It was a grade A income statement. Their revenue went to $96 billion plus from $84 billion. If you look at income from operations, it went to $31.2 million from $27.4 million in the same quarter last year. Net income went to $28.1 billion from $23.6 billion. Diluted EPS went to $2.31 versus $1.89. Does not look like a company that is having their lunch eaten by ChatGPT or anybody like that. Looks like great numbers, and that's all Google has to do. Keep putting up the great numbers quarter in, quarter out, and all this fear about, ChatGPT is going to eat them, blah, blah, blah. It's all going to go away, right? Because at the end of the day, we see Google doing what? Increasing their revenues massively. I mean, they made almost $12 billion more in a 3-month span than the same quarter last year. The death of Google has been greatly exaggerated. Now, total cash equivalents, marketable securities on Google, $95 billion plus. Non-marketable securities, 52 plus billion versus 37 billion in the same quarter, or actually not even the same quarter last year. This was back in December 31, 2024. Look at how much the non-marketable securities has increased. If you look at shareholder equity, 362 billion versus at the end of last year, 325 billion. They're increasing that rapidly. And by the way, non-marketable securities, I basically look at it as long-term investments is what I call it, okay? But usually it's kind of like assets that are on the balance sheet that you can't, they're convertible to get out of, but it's not like you can get out of it tomorrow necessarily, right? Like a savings account or something like that. So non-marketable securities are investments such as U.S. savings bonds, private equity investments, certain government securities that are not traded on exchanges, have limited liquidity, meaning they cannot be easily bought or sold in the secondary market. So that's what differs versus, let's say, like a marketable security. Non-marketable securities are usually, the way I was taught in accounting way back in college is this kind of things that, might be more than like year plus investments, and these are like less than a year. That's the way my accounting instructor kind of put it the simplest way possible. Now, what about projections for Google? Because I have projections for Google. Okay, listen. we got a new beautiful feature on 1000xstocks.com where essentially you can now save your projections. So before you used to just, be able to do a projection and that was it. Once you cleared the page, that was it. Now we allow you to save your projections, which is going to be a lifesaver for me because I end up creating so many projections for so many companies. So we launched this feature like a week or two ago. I've already saved up a few. I got a lot more to save over the next few months here. But I went to Google, brought that up, and here are my Google base case, bear case, and bull case for the stock and where I see the stock price going over the next few years. My base case for Google, and keep in mind, my base case is usually very conservative. I've been doing 10% revenue growth per year over the next few years from 2026 to 2029. I've been doing 12% net income growth, not a crazy number at all, per year over the next 4 years, right? P ratio of 23 to 28, very fair number for a company like Google. That gives me a compound annual growth rate of about 15% on the low end and 20% on the high end. Easy peasy, lemon squeezy, give me the money, pleasey. Bear case, my bear case for Google has them doing only 7% revenue growth per year the next 4 years, okay? 8% net income growth per year for the next 4 years on average. That would still give me, even at a 20p on the low end, 25 on the high end, it would still give me a compound annual growth rate of 7% to 13%. I mean, if you're going to give me that on a bear case, I got to take that opportunity. Like, it's just too easy of money. Like, even in a bear case scenario, I probably outperform the S&P 500 because I'm not even convinced, we can call that a midpoint of 10% CAGR. I'm not even convinced the S&P 500 will give a 10% CAGR from 2026 to 2029. I'm not convinced at all. And so the fact that I could get that from Google in a bear case, I mean, I got to buy the stock. I don't know what else to say, right? That's why you see me buying the stock almost every week right now. As far as a bull case for Google McDougal, I have them doing 12% revenue growth per year on average, 2026 to 2029. Net income growth of 15% on average. 25 to 30 P ratio for a company growing, low to mid double digits on top line, bottom line. It gives me a CAGR of 20% low end, 26% high end. I got to buy it. You know what I mean? Like Google, it's just money, man. It's just money. Do you want to make easy money? Do you not want to make easy money? You tell me. What do you like to make? I don't know. I like that you make easy money, man. So, all right, next one up here. Number 3 of these 4 stocks. I've made hard money before, and I like easy money a whole lot better, okay? Stock number 3 of these 4 stocks. I love this stock. I so love this stock. This stock represents one of the most perfect companies in the stock market, in my opinion, of really giving you an extraordinary growth opportunity where this company has really this next company we're about to get into, they have the next 10 years of growth set up for this company. Not the next 10 months, not the next 10 quarters, the next 10 years of growth set up for this company. It's a great value stock. It's a great dividend stock. And they've had the worst situations you could ever imagine thrown at this company over the past 5 years. 2 of the worst situations you could ever imagine being thrown at this company got thrown at it in the past 5 years. And yet this company has emerged stronger, not weaker, stronger than it's ever been at any point in this company's history. It's a very, very beautiful company. And that is Cheesecake Factory. Oh my goodness, do I love this stock. It has performed very well over the past 5 years, up 162%. That does not include all the dividends also this company has paid out, but it's been a drama show for this company over the past 5 years, right? But here's the deal with Cake. You gotta understand, this is one of the most miraculous companies, I think, in the market. They've had 2 of the worst situations you could ever imagine thrown at this company in the past 5 years, right? They had to go through a once in 100 year shutdowns back in Rona, right? Where their restaurants were forced to be shut down. And then when they were finally allowed to be open again after being closed for a long time, what happened? They were only allowed to have limited options, limited seating at their restaurants. You had to do all you can't get too close to this person, so this table needs to be way over. What a disaster, right? And a lot of restaurants didn't make it. A lot of restaurants did not make it through that. A lot went under, went out of business forever. They closed their doors and that was it, right? Then, what happens 2 years later? We go through the highest inflation in the United States of America that we've gone through in decades. decades, as in like 4 or 5 decades. Incredible inflation. And that devastated so many restaurants because so many restaurants were not able to essentially pay the workers what the workers started demanding for wages. And then they had to start paying crazy prices for like a tomato and beef and chicken and all this stuff. Like pricing just went insane, and eggs. And so a lot of restaurants could not make it through that inflation cycle we had to go through, right? And so if you got through that, if you got through those two disasters for the restaurant industry, and ask anybody that's run a restaurant in the past 5 years, they'll tell you, brutal. What a brutal time. I mean, restaurant business is always brutal, but this has been an exceptionally brutal time period the past 5 years. If you made it through this, you're strong. The company's stronger than it's ever been on a financial front. You look at the income statement, you look at the money starting to pour in, you look at the balance sheet, you look at how well positioned the company is, you look at the stock price, it's never been stronger than it is, and it had 2 disasters thrown at it in a 5-year span, right? Now, when it comes to Cake, this is a 6-prong investment, I call it. Okay, where there's like 6 prongs to this one that make it such a compelling buy now. It was a buy yesterday, it was a buy the month before, it was a buy last year, it was a buy the year before, it's a buy next year. 6 prongs here. Prong number 1 is the Cheesecake Factory itself. Like that's an ATM machine of a business model. They're packed all the time. They do crazy numbers, right? It's, you know, one of the greatest restaurants in the history of mankind in terms of just being able to make incredible money per restaurant open. Like, it's ridiculous. You can look at the unit volumes Cheesecake Factory restaurants do. It's ridiculous. It's insane. Okay, that's prong number 1, ATM machine. Prong number 2 is North Italia. North Italia is really going to fill a void over this next, I would say, several decades, essentially, in the United States of America, like Olive Garden kind of filled in the last few years. Or not just the last few years, last few decades. Olive Garden expanded across the United States of America. They filled a void of like an Italian restaurant. And nowadays people realize like Olive Garden quality of food's not very good, right? The restaurants look super outdated. It's not like it was, 20, 30, 40 years ago, right? So North Italia is coming in to really fill this void with much higher quality food. Like not even remotely close. Like Olive Garden's, if you've eaten good Italian food, Olive Garden's a tough eat, right? North Italia's coming in with great food. They're coming in with restaurants that actually look amazing. That actually, like, if you're somebody that has some taste in terms of like going somewhere, like you're like, oh, this is a nice place. This is a classy place, right? And still coming in with a price point that's not just like, oh, only rich people can go there or something like that. So that's coming in. That's just massive expansion. We're going to see, you're going to see multiple locations in pretty much every big city within the next 5 years for North Italia. Okay. Prong 3, Flower Child. This is an insane concept. This is the most exciting thing, I think, in the whole company. This is more exciting than North Italia. This is more exciting than the Cheesecake Factory itself. Flower Child, we have an opportunity with Flower Child to expand this to locations like you could have more Flower Childs than you have in total restaurants if you combined all the other brands 10 years from now. When I think about Flower Child, this is a perfect concept for really this next 10, 20 years. And the reason being is Flower Child is a concept that really focuses on healthy food. You don't have a waiter or waitress type experience that is very different from like a North Italia, like a Cheesecake Factory. You just go up there, you look at the menu, you say, oh, I want the global and, with shrimp or something, whatever you want to get, right? And they make it for you. It's very high quality. They fresh make it for you. It's delicious. And they bring it out to your table or you get it to go. Also, it's capitalizing on the whole to-go business. From my understanding right now, they have an exclusive relationship with DoorDash only, from my understanding. But I wouldn't be surprised if 5-10 years out there on all the different, food operators platforms. And that's just a crazy opportunity, right? Because if I think about all that Uber Eats, DoorDash, all the food delivery, like that's just going to continue to get bigger and bigger. And it's a perfect concept that can work in the suburbs. It can also work in the office environment and corporate areas where you're doing big lunch volumes, big breakfast volumes, right? Or maybe people after they get off work. So Flower Child works just about anywhere. So I love that one. By the way, I had to mention this because at the exact time I was doing this screenshot of Flower Child, a classic came on. A classic. You're a Flower Child. Like it was crazy timing. And I'm like, oh my gosh, like I got to record this. Right? I mean, I got to take a photo of this. Like it is ridiculous that the fact that I happen to be taking a Flower Child screenshot and Flower Child came on a song. I'm like, that's like, what are the chances of that, man? That's crazy. Prong number four, when it comes to this investment in Cheesecake Factory is around Fox Restaurant Concepts. This is something they own. They own a ton of different brands here: Culinary Dropout, Blanco, the Henry Doughbird, Obviously, we already spoke about Flower Child, Flyby, all these different brands, right? I love Olive and Ivy. No, this acquisition Cheesecake went through, this is what, Facebook buying Instagram, what that meant for that business is what this deal will end up meaning in the end, in my opinion, for Cheesecake Factory, okay? And so they did this deal back in 2019. Then obviously we went through Rona in 2020. Everybody forgot about it. It's one of the most magical deals ever. They were able to get the Fox restaurant concepts from a gentleman named Sam Fox. I think this is a legendary restaurateur. I think he's, one of the most amazing, at least, in the United States of America, one of the most amazing restaurateurs in the United States. Okay, what else am I going to say? Like, dude's a legend. Like, you can, if you ever want to do some research on Sam Fox, who he is, what his deal was and whatnot, you can do it. There's been plenty of articles written about him over time. The man's very exceptional when it comes to the restaurant industry. And I've been to so many of his restaurants, which once again are all owned by Cake now, and I'm nothing but insanely impressed. Like, ridiculously impressed. And believe me, Cake wouldn't have done this deal unless they were like, dang, he's got something special here. And from my understanding, Sam Fox just didn't want to try to grow this into a massive company like a Cheesecake Factory or a Texas Roadhouse or something like that, right? And so he handed off. He got a crazy 9-figure exit from it. Good for him. And he said, Cake, you can take it from here. And I don't know, he might have Cake shares. I hope he does. I would love to see him prosper from Cake over the years as well. I don't know if he does have Cake shares, but I hope he does, because, his concepts are going to come in clutch over this next decade, okay? Now, in terms of Cake, prong 5 of why this is such a great investment is really around valuation. Forward P on this one, 17, 2-year forward P, 14, way too low. For a company that's got the next 10 plus years of growth ahead, way too low. Way too low. That shows me people still don't understand this. The forward P on the stock should easily be in the 20s or 25s right now, okay? Prong number 6 when it comes to Cake is dividends. This was just paid out to me in the public account here a few days ago. Cheesecake paid me $868 in dividends there. They pay their dividends every 3 months. There's another portfolio of mine. They paid me $459 dividends. I own Cake in other portfolios as well. So you add it all up and I made a lot of money just in dividends in the last 3 months. And that's great. I love making that dividend money, because then you know what I do with the dividend money? I go buy more stocks with it. Sometimes it's other dividend payers. Sometimes it's growth companies. It's a beautiful thing. Okay. So Cake, love that one. Number 4 of these 4. Oh, actually, no. Excuse me. Hold your horses for just 1 minute. I got to do honorable mentions. There's a couple honorable mentions I got to mention before we get to stock number 404, and that is Adobe. ADB, honorable mention here today. Stock's done trash the past 5 years. I think it's going to do very well for itself over the next 5 years. And so Adobe's a stock I started buying here somewhat recently, and I might want to buy some more shares. So honorable mention with Adobe. Another honorable mention is Nike. I love Nike as a buy the last few months. The stock's already bottomed. It's heading up from here. I think Nike's got a great next 3 to 5 years ahead of this company. We're going to see a lot of an inverse of this chart basically over the next 5 years, in my opinion, for Nike. Okay. All right. Now we can get into stock number 404, and that is FuboTV. FuboTV, $3.53 stock here today. It should not be there. Stock's up about 69% in the past year. Now, Fubo, very exciting news just came out a few days ago in regards to this. FuboTV is launching Fubo Sports, a skinny bundle. It's supposed to launch on September 2nd. Now, what do you get with this package? The package is going to be around $55 or so. You're going to get ABC, CBS, Fox owned and operated stations. Plus, you're going to get ESPN, ESPN2, ESPN News, ESPNU, ACC Network, Big Ten Network, CBS Sports Network, Fox News, FS1, FS2, the Fubo Sports Network, ION, NFL Network, SEC Network, and the Tennis Channel. Now, this is a big deal. You're going to get potentially some other stuff as well. But, this is a good package for I would say an average sports fan. If you're really, really crazy about sports, there might be a few things that you don't quite get in that package that you might end up opting for a package like I have, which I think I pay like $100 a month or maybe a little over $100 a month for Fubo. But this is going to cover a lot of people. And so a lot of people will be very interested in this and likely end up signing up for a product like this, right? Now, they're going to do this kind of like tester price, where essentially the first month is going to be $45. And then after that, it goes to $55. I'm not a huge fan of this. Maybe some people are like, oh, cool, I get it for a discount the first month. I just wish, like, if it's $55, just say it's $55 and just leave it at that, man. Take it or leave it, right? And so, it's like what we're doing with the Patreon sale. It's not like I'm like, oh, it's $49 the first month and then it goes to $125. No, it's $49 after that as well. It's not like, it doesn't jump up. So, but it's this day and age. I guess people do this, but whatever. That's the deal with the pricing there. No, for Fubo, the fundamentals of this company have changed, to a ridiculous extent. If you look at adjusted EBITDA, right, which adjusted EBITDA factors in things like depreciation, amortization, stock-based compensation, a lot of these like non-cash expenses and whatnot, right, or one-off expenses like litigation, transaction expense because they got a big Hulu deal that's going through right now. That's a bunch of one-offs in non-cash expenses. So when you adjusted EBITDA was $20 million plus. If you look at this same quarter last year, right, adjusted EBITDA was negative $10.9 million. So we've had a complete flip in the profitability of this business model. Now, the company's sacrificing revenue growth right now, right? If you look at revenue growth, there's no growth in revenue right now. And the reason being, in my opinion, is because the Hulu deal should be going through very soon, right? So Fubo's supposed to get essentially the live TV portion of Hulu, right? Fubo's supposed to get that. So that deal's supposed to go through. You got the skinny bundle, which is going to be launched here very soon, and that's going to have a full year of launch in 2026 and a full year of marketing behind it in 2026. Revenue should boom for the company in 2026. So in my opinion, you basically sacrifice revenue growth right now because you're going to have so much revenue growth, you're not going to know what to do with it next year, right? Now, if you look here, they're sacrificing that and they've improved their profitability immensely. Look at this. You went from an operating loss in this same quarter last year, $35.6 million. Operating loss in this quarter, $5.9 million. What a recovery. Oh my gosh, one for the history books. Now, additionally, look at cash and cash equivalents for the company. Up to $283 million in cash and cash equivalents. Do keep in mind, from what I remember, on the legal front, if for any reason the Hulu live TV deal doesn't go through, let's say the courts block it or something like that, from what I remember, the company is supposed to get 9 figures. If the deal doesn't go through, now I hope that deal goes through, I'd love it to go through, but if it doesn't, from what I remember, the company's supposed to get 9 figures. Keep that in mind. So that would just build the cash extent to even a much higher level. So the way I view Fubo is, you guys remember when DirecTV and Dish Network were really in their heyday, right? Which was kind of like the mid 2010s. And I view YouTube TV and Fubo as kind of that Dish Network DirecTV where, YouTube TV is going to continue to be the biggest, right? And Fubo is always going to be that competitor behind them. That's always, smaller, but still very, very successful. And so when I look at Fubo, I think it's kind of a joke. The stock's $3.53 today. This stock should not be anywhere near the Gulag. If you don't know the Gulag, that's stocks that are priced under $5. It should not be there. This stock should be over $5 right now. Look at the balance sheet of this company. Look at the skinny bundle coming here. Look at the Hulu deal that's supposed to go through here, right? There's no reason the stock should be priced where it is right now, and it is, and I think it's a mistake. I think the stock should be well over $5 right now. And then, if they get back to very nice revenue growth next year, we could be talking about a stock that goes double digits next year, $10 plus. We'll see how it all shakes out. But I like Fubo. I like Fubo a whole lot, okay? Appreciate y'all for joining me. As always, thanks so much for being here. For the people that are viewing this video in the first 24 hours, that Patreon sale for my highest end Patreon tier will be going on. $49 access instead of $125 usual access. That will be pinned comment down there to get that deal. Enjoy that. Enjoy that. Enjoy that. For the people that are not watching this, within that first 24 hours of this video coming out, and let's say you want to apply to join my private stock group, get access to 1000xstocks.com, all that, check out the description area down there. There's a link in the description. You can click on that. You can fill out that and see if you can join us in the private stock group, get access to 1000x and all that good stuff, okay? But for everybody getting that Patreon sale, enjoy it, okay? Much love and have a great day.